Hey guys, Brant is in the room.
Okay.
Um,
Yeah, well, want to welcome Brant Hackney,
Okay.
founder of Wolf on Wall Street.
Okay, thanks.
I've been with Brant. I'm not sure. He can probably tell me. I think 10 years.
Kirk, at least 10 years.
Okay. Very rarely miss any posts of Brant. Excuse me for that 10 years, but I'm not sure how I came across Wolf on Wall Street. I have no clue, but glad I did. Been there for a long time. Fascinated with 3C. And so I appreciate Brent taking some Saturday morning time and joining us here. So everybody welcome Brent Hackney.
Thanks for having me, everybody.
Have you got Art's itinerary that he put
Yeah.
together? Thanks
Yeah,
for
I did.
doing that, Art. You did a great job on that. So we can kind of go by that, I guess.
Yeah, there was a list of questions that I put together, just a couple brief answers. So do you want to start with that and go through some of that?
Yeah, sounds good.
Okay, so what is 3C? It's just a proprietary indicator that I created. Proprietary just means I designed it. It's not anything really spectacular as far as programming. I'm not like a programming genius or anything like that. It's based on Don Warden's time segmented volume. So these are kind of Don Warden was kind of a pioneer of money flow indicators back in the 1950s, and kind of the appeal of technical analysis back then, when institutional money was about half of what it is now. It's not like a massive tide like it is now that washes in and out. The appeal of money flow indicators was that inside information was being traded like crazy back then, and you could pick up on subtle little differences in these money flow indicators that have the power to contradict price. Instead of just moving with price, they have a power to contradict it. So that was kind of the genesis of money flow indicators. Don Warden created the first one, which was called tick volume, and then there was one that came out around the same time. On balance volume came out around the same time. That guy published it first. Don Warden went to Wall Street and sold his. So the other guy got credit. But the point is, he's been doing this for a long time. He's passed away now. So there's a little thing I just pulled from Investopedia, just that defines time segmented volume. It says proprietary technical indicator developed by Warden. It's an oscillator. Okay, so that means it's bound in a range from 0 to 100, similar to like MACD or something like that. And it's
Brant,
calculated. Yeah.
You have a chart you want to share
Of TSV? Sure.
your screen?
Yeah, let me pull one up here real quick.
Traders, we just want to see charts. We don't care about
The TSV 38 is basically the time segmented volume with a moving average of 38 bars over it. And then there's this other moving average of TSV, that's a 19 bar. So like I said, it's an oscillator. And basically the idea is over this zero line here is money coming in, below the zero line is kind of money going out. You can use it in the same way you'd use a lot of indicators with divergences. So, when you have a flat range over here, you can see it's making a lower high here relative to price. So you can use divergences as well. So what I pretty much kind of did with, let me pull up my little thing here. What I pretty much did with 3C was to take time segmented volume and take out all of the averaging, because when you average data, you lose data. So if I showed you what TSV looked like with like no average on a 1, it's like unreadable, right? I mean, you can't get anything from that. So that's why they average it. And what it does is it looks at different segments, time segments of the market, price and volume, and then compares them to one another. So what I did with 3C, and I'll pull that up here. Okay, so this is 3C. So what I did with it was basically take out all of that averaging, so the data is as pure as possible, and then turned it into a cumulative line instead of an oscillator that's bound by the 0 to 100 range. So in theory, what 3C should do is track with price most of the time, which would be something that I would just call confirmation. It's like confirming the trend. So if price is making higher highs, higher lows, 3C 3C should be doing more or less the same. Then you have divergent signals. So Kirk, you may know this, like the last several weeks I've been saying, QQQ's chart on 3C looks the worst to me. And that was back here in this area. And we've since seen, 3C go a relative divergence here, which is, price is making a higher high, 3C is not making a higher high. That's a relative divergence. And then, right about here, it starts to lead price lower. And it just keeps leading price lower, and eventually price is catching down to it this past week, right? At this bottom, there was kind of like a little bear flag that was forming up, and we might have gotten like a second leg down from that, but it tested that support here and held. But if you look, 3C is positively divergent at the first low, which just tells me the probability is that there's going to be some kind of consolidation there. But at this test, it's more positively divergent, and that tells me that this low is more likely to hold and to bounce, and that's pretty much what we got, and bounced up into this gap, which is also a large range of overhead supply there. But if you look at this bounce, as of the close on Friday, 3C is still in line with price over here. It's tracking with price. So I would assume that into next week, this bounce kind of continues a little bit, or tries to continue a little bit. But like I said, there's a big range of supply. So that's kind of what I do with 3C, but I've had a lot of different members do a lot of different things with it. There was an interesting kind of article I saw on Seeking Alpha, where somebody was talking about Don Warden. He had just passed, and a little quote, he had the foresight and vision to recognize that whether a large lot transaction ticked up to the upside or to the downside mattered far more than whether prices moved up or down. So that's kind of the theory of these money flow indicators, is that they have the power to contradict price. And like I said, with 3C, I just removed a lot of that averaging, tried to keep the original TSV data as pure as possible, and created a cumulative line so it tracks with price rather than it's bound in an oscillator. What differentiates it from other tools in a trader's toolbox? Like I said, some of these money flow indicators do have the ability to contradict price. So that can make you aware of underlying accumulation or distribution, or when it's moving with price, basically confirmation. So if I'm long something and 3C is moving with price, I don't have a reason to get out of the trade based on 3C alone. So one example I remember, Kirk, you might remember this, that 2017 melt up, the tax package was passing, Trump's tax package, and we had this melt up into 2017, late 2017, early 2018. Then the market crashed in 2018, really early, and volatility exploded. But one thing I remember very clearly back then was there was a really strong rally at first, and then one after another, like every couple of days, sectors, all 11 S&P sectors started negatively diverging. And it was just, we knew something was up. There were some other things that I'll talk about in a minute that go along with that. But that's one of the things that I look for a lot with 3C, is not just one signal. I look for as much confirmation as possible. So I'll look at all 11 S&P sectors. I'll look at the S&P. I'll look at the Nasdaq. I'll look at small caps. I'll look at volatility, and volatility is doing the opposite signal of what I'm seeing in SPY. That's kind of a confirmation as well. How does it work? Again, confirmation, divergence. So I'm looking at the trend of 3C versus the trend of price. So are they making higher highs, higher lows together? And then I talked about those relative divergences and leading divergences. I think those leading divergences are much more powerful, much more interesting. A lot of times a relative divergence just means there's going to be a pause in price. Again, I can pull up this QQQ chart because it's been a pretty cool example recently. And right about in here, you can see 3C starting to negatively diverge, and prices start moving sideways. As 3C leads lower, prices start to lead lower over here. I have one other really interesting thing I just found out. So let me pull that up. So I was reading, and I think this was Thursday, this was out. So this is from Goldman Sachs Prime Brokerage. It says tech stocks were net sold for a 7th day. This would have been out here on the 5th, this note. And 9 out of the past 10 days, and more importantly, the bulk of the selling was short selling. The flows were driven by short sales outpacing long buys 2-to-1. Okay, so this is the source over here, Goldman Prime. Everybody can see that. So if we go back 9 days or 10 days or so, that's basically right here. I don't know this at the time that, what's actually moving 3C, but in retrospect, with this news out on Thursday, that's exactly what we're seeing here, this divergence. This is all of this net selling in tech. So I thought that was kind of an interesting example. I've seen stuff like that before, but a little bit of an interesting example. And I presume over here, when we got this test of the low, and we have a more positive divergence over here, you can see the higher low in 3C relative to prices making an equal low. I presume that's basically some short covering, and I think that's what we saw on Friday, right up into this gap. So the next question was, can it work across all asset classes and all time frames, from SPACs to SPY to VIX, anything that has price and volume? Okay, so one of the things that Don Ward noticed was that if you are only looking at price, the power to contradict price is much, much smaller. So it's a price and volume. As long as the asset has price and volume, you will see some differences in like really low liquidity, kind of like penny stock stuff, or stuff that moves in really small ranges, again, in that penny stock kind of atmosphere. But basically anything that has price and volume, it will work with. The next question, I had some additional notes on this. My preference is finding one time frame, and this isn't just 3C, this is like any indicator, really. A lot of people bounce from indicator to indicator, and they're looking kind of for that holy grail, the one that really, the market is uncertainty. So you're going into battle, you want as much certainty as possible. People are out there selling indicators, as the holy grail. There really is no holy grail to indicators. They're, to me, a lens, a tool. So I like to find one time frame. Personally, I will go through, if I'm looking at a new asset, I will go through multiple time frames and see which one maybe looks synced up with price the best, or has kind of performed historically pretty well. But I prefer one. It doesn't matter which one, it just depends on your trading. I think it's more important to get to know the indicator, how it acts with price over time, than it is to pick, the best time frame. I think it's more important to know what's normal, and to know what stands out as unusual, and to know what jumps off the chart. The stuff that jumps off the chart is the stuff that I usually trade. I think it's really important not to be biased and cherry pick time frames, because, I'm not going to say we all have a confirmation bias, but, I am aware of mine at times. So I think it's important, if you're using one time frame pretty consistently, and then you go through a couple others and you see, if there's overwhelming evidence, that's a different thing. But I think you just have to be very aware of that bias and not cherry pick time frames. If you're not seeing.
Hey, Brent, can you show us a chart where you've got 3C jumping, like you say?
Recently, because the market has been in this, like, and the SP has been in about a 1.7% range for almost a month. So recently there hasn't been a lot of movement, a lot of choppy stuff. The QQQ example is really the best. I'll pull that up again here. It's one of my favorites, just from what's gone on in the market recently, because QQQ, basically all the averages were in some kind of a range, except maybe small caps, but S&P was in about a 1.7% range. The Dow was in a range. QQQ was in a range. They're between 3 and 4 weeks long. That typically happens a lot. You see that a lot in earnings season. These ranges develop. But Kirk, you keep up with the updates, so you probably recall over the past couple of weeks, I keep saying, QQQ looks the worst, as it's been doing this and leading lower and leading lower. And then we got this big breakdown this week. What was it? Tuesday morning, and on big volume. And like I said, this to me jumps off the chart. I'll show you a 5-minute chart here of QQQ. And this 5-minute chart basically is going to have less sensitivity. So it's going to track more with price. But that range, that area I was just talking about, is right in here. And you can see that negatively diverging right in here. you do have a very slight relative positive divergence over here, very, very slight. But let me show you SPY real quick. And one of the things I'm talking about, a lot of times when 3C does diverge, it doesn't necessarily mean price is going to reverse. Over here, it's starting to diverge. You can see price is making higher highs, higher lows. 3C starts making lower highs right over here. And a week later, we're in this lateral range, or this is actually the start of this lateral range. So again, it's not necessarily to say the market's going to crash because 3C is diverging, but there is a change in money flow. And then we start moving into this lateral range. This was starting to really get kind of ugly. And this I definitely would consider a leading divergence, because if you look at where price was over here the week of the 22nd or so and where 3C was, look at where price is now, and 3C is lower than it was over here. So I would consider that a leading divergence, a leading negative divergence. With this kind of breakout above the range on Friday, a little bit of improvement here. You can see the higher highs and higher lows, but generally speaking, this divergence here was kind of reflecting this range coming. And if we look at QQQ again,
that's exactly what I do too. I look for two pivots. I'll look for two important tops or bottoms, then look at 3C relative to price. And that's about it, really. I mean, I'm looking short. This top up here, I'm looking short on that top.
On the S&P.
Yeah.
Yeah, I mean, it had a false breakout last week.
Right.
Actually, QQQ had a false breakout too, and I kind of talk about this concept once in a while from like these failed breakouts or head fakes or bull traps. Come these real fast reversals.
Yeah.
Let me see if I can just pull that up real quick. Sorry, I'm still really fumbling around with this sharing, but
you're doing a great job. Thanks, Brent.
Yes, first time I've used this. For somebody who's on computers all day, I'm like really not very tech savvy. But
me neither.
I don't believe that for a minute. I don't believe that.
You can ask these guys. I'm a loser.
We can vouch for that.
Yeah, he's really terrible.
I'm not sure I believe that, but all right, I'm gonna try to share this. I don't have any trend lines drawn on this, but I think you'll get the gist of it. I can probably throw some up real quick. They're not gonna be perfect, but so can you see the screen of QQQ?
Yeah.
White screen. So let's just say, roughly this is that range I was talking about. And last Thursday, we got this little breakout here, breakout attempt.
Yep.
This was not the strongest head fake or bull trap that I've ever seen, but the concept I talk about a lot is when you have a failed breakout, a lot of times you'll get a fast reversal. And I was kind of expecting, Nasdaq to come down to the bottom of this range, but it just sliced right through. So there's your failed breakout. There's your fast reversal to the downside. And now we've got, what started out as a little bear flag here. It tested, held that low, and filled this gap. But, you still got a pretty decent zone of overhead supply there. Whereas if you look at the S&P 500, sorry about that. S&P 500, you can see that range right about here and that head fake right about here, and it came down towards the bottom of its range. But it, because of what's moving the market right now, what's making tech more sensitive to downside, to rates, to inflation, I'm not surprised the S&P kind of held in that range and broke out. It followed the Dow to breaking out. But the point I'm just getting at is usually these head fakes or false breakouts or whatever you want to call them, a lot of times they just reverse really fast. So that was something, we were seeing in QQQ. And getting back to that 3C QQQ chart, for weeks, it was really looking the worst out of all of them. So the next question. Oh, I had another note. He asked about, can it work on SPACs and SPY VIX, which I said, as long as it has price and volume. There are some things that I prefer over the other. When I'm looking at volatility, I like to look at Vix Futures on an intraday basis. So if I suspect, we're like right before a Fed meeting, they almost always sell volatility. I think it's the New York, Federal Reserve open market desk out there selling volatility to make sure the market's calm while the Fed meeting goes on and that they're not influenced by some reaction in the market to their decisions. But you almost always see it. And I almost always look at VIX futures first to see that selling pressure or when it's kind of abated. And VXX I prefer for more of like a trend. So if there's a divergence going on for a week or so, VXX will tend to reflect that a little bit better. But these are just things, I notice. And the gist of the question is, yes, it can work on all time frames and different assets as long as there's price and volume. What's the source of the data? So we kind of got into that. It's based on TSV, time segmented volume, which is a proprietary indicator. There's a couple of people who've like made knockoffs of it, but they don't publish what the actual formula is. So the TOS version that some of you guys are using, that is an approximation of TSV, and it's darn close. I mean, it's close enough for what we need to do, but it does look a teeny bit different. And when you move from platform to platform, they use different data feeds. So sometimes there's little differences in different indicators, what is the greatest strength to a new user and how should they attempt to use it in their trading? I view 3C as a tool. I don't view it as a holy grail. So for me, it's just a window into what may be happening under the surface of price that you don't see just from price alone. To be very clear, it's not a holy grail. I'm not out there selling it. I'm not out there, promoting it as like, join my website and you'll get this. I generally don't give it out to many people. I give it out to people that I know who've seen the indicator at work on the website, who are used to seeing it. So it's useful in a couple ways. Like we said, it has a pretty uncanny ability to pick out bottoms and tops. And then in the middle of the trend, it has a pretty decent track record of confirming. So making higher highs and higher lows with price, or lower highs, lower lows with price, which would just tell me if I'm in a long trade, that I feel pretty good staying in and that I don't see any obvious distribution or anything like that.
Grant,
so yeah.
Could you show us a chart that displays what you just said about how to stay in a trend?
Let me pull up 3C.
Would Ethereum be an example?
We can take a look at that in a minute. Let me pull up. Okay, so here's SPY 5-minute chart. Like I said, this isn't going to show you as many intraday details. It's more of a trend. The 1-minute chart is going to show you more of the pivots at little individual levels. But I've seen a lot of people really zoom these in and look closely and get the same effect. You can still see a divergence here. But let me show you the Dow, which broke out above the range before anything else. 5-minute chart. This may look a little bit sloppy, but it's basically moving with price. Over here, it's even leading price. So you can see this little kind of triangle or flag consolidation in price right here. And 3C just rockets up way past it, makes a new high well before price breaks out over here to the upside. So it's kind of tracking along with price. This is confirmation. I mean, you could pick out a few little divergences here and there, but if you look at it in totality, it's pretty much moving with price. Whereas if you look at SPY, it was moving with price until this area here where that range came in, diverged. Towards the end of the week, looks a little bit better because I think we got a lot of short covering in those tech stocks in the tech sector, communications, and consumer discretionary. The mega caps that have really been getting hammered by higher rates or inflationary data. So that's kind of a difference between a divergent chart and, again, with the Dow, one that's more in line with the trend that looks healthier. 3C hasn't made a complete higher new high, but it's a 5-minute chart, so sometimes it takes a little bit of time to get there. But personally, I wouldn't be shorting Dow based on this chart unless something, some other probabilities made it really attractive. I am still leaning more towards SPY and QQQ, especially.
You hear that, Kirk?
Yes, sir.
Okay.
Why was Kirk thinking?
Add short.
Which index?
Everything.
Yeah, I think right now there's some short covering going on in Nasdaq because, like I showed you that little caption from Goldman Sachs Prime, how much selling in tech had happened over the last 2 weeks and how much of that was actually short selling. So I think, we are getting some of that short covering, which is what we saw on Friday. But from the macro perspective of what's going on with inflation and considering the historical, record valuations, I think tech is really at probably the most risk to the downside. So that's, in my opinion, NASDAQ 100 over the NASDAQ composite, because that's where you have a lot of those large cap or mega cap tech stocks. To me, I think the diamonds look a little bit better than everything else. So I'm going to stop this and just get back to these questions here. The question again was, what's the greatest strength for a new user and how should they attempt to use it in their trading? I use it, I view it as a tool. So it's not a holy grail for me. It's not the only thing I use. Kind of uncover some stuff under the surface, or can useful in confirming the health of a trend, like we just looked at with the Dow. Like I said before, it often picks up on pivots, on tops and bottoms. A lot of times I'll run through all 11 S&P sectors, and I might notice, like I was saying, in 2017, we had this monster rally, as the tax cuts were going through into early 2018. You might remember the crash in early 2018, volatility exploded. But right before that, it was like one sector after another went from confirming to negatively diverging over a period of maybe like 2 weeks. And it was like, I was telling members back then, something is coming here. And nobody could see that at the time because the market was just levitating every single day. The more confirmation among various stocks, sectors, averages, volatility, the better. So 3C is just a reminder to me that compare. That's all it stands for.
Brent, could you pull the chart up? What of that time frame you're talking about that you've mentioned 2 or 3 times now?
I would have to go. Are you talking about 2017?
Yeah.
Yeah, I would have to go back and pull it from the website because I only have about 2 weeks
okay, never mind.
Of historical data on those time frames.
Okay.
Which is one of the reasons I like Stock Finder over TOS. I get, almost 2 weeks of price data on a 1 minute chart, whereas on TOS, I think it's maybe 3 days or something.
Mm-hmm.
Again, I think the most important thing for a new user is to get to know the indicator in the time frame that they trade. So get familiar with it. And it's, it's not an indicator that's out there in the public forum where a lot of people have used it and found different ways of using it. So I see a lot of people using it in very different ways than I do, but the divergence confirmation concept is all the same. They might be using different time frames. They might be seeing different insights, and none of that is wrong. So I encourage people, as long as they understand the concept, to make the indicator their own. So a lot of things that some of you guys have brought up to me, Kirk and Art, I can't disagree with them at all. I haven't used 3C that way. I haven't looked at it that way, but all of our minds work differently, how we view things, how we trade, what time frames we trade. I have like a very skeptical mind. So things that aren't obvious stand out to me. I kind of look for unusual stuff that might go under the radar. It's just how my mind works. So question is, what timeframes would you encourage a new user to begin with? I like the 1 minute time frame just because of the way I look at markets, and I'm doing this all day. But I've seen people use 4-hour time frames. I've seen them use 5 minute. I've seen some people use daily. I don't think it's as sensitive. But I think it's important just to use whatever time frame you trade in. I think it's important to get to know the indicator, get to know what's natural, what's normal, get to know what's like a little bit unusual, and get to know what's jumping off the chart like really strange. And those are the signals that I like the best. Are there time frames that you've learned it does not work? And if so, what are they? Really, I think if you run through like one asset through a whole bunch of different time frames, and I used to do this every day, I would go through 1 minute to 2 hour, 4 hour charts. You'll find some time frames at some points in some assets work better than others, but you have to be able to really draw the line of not cherry picking. So the more you use it in one time frame, you'll get used to how it acts, and they'll act a little bit different in different time frames. 3C will look different. I'll give you an example here. Let's pull up, let me pull up SPY again. Yeah, this is probably a good example, actually. Okay, so can you guys see the SPY chart with 3C orange?
Yeah.
Okay, so this is the 5-minute chart. You can see where it started negatively diverging here about mid-April and went into that kind of flat range. And if we go to a 60-minute chart, scaling is a little wonky, but let me zoom it in here. So over here, you see pretty decent confirmation. There's small divergence here, small divergence there, nothing big. So if you look at the 60-minute chart where it's diverging, it's literally almost the same spot over here. You know, it's lagging a little bit because the 5-minute chart is picking up on the signals faster. But if you have a stronger signal on a longer time frame, it's a more significant signal because these diverge less. There's got to be really something going on under the surface to move these longer time frames. So like I said, I kind of look at these shorter time frames and they really stand out in definition with that kind of a divergence. But if you're looking, that's the 5-minute, but if you're looking at a 60-minute, what I see a lot of people who are using these longer ones do is they'll zoom right up in on it and say, okay, well, over here, 3C is making higher highs. Over here, it's kind of flat. Prices are correcting a little bit. We start going in this lateral range. Now over here, a strong leading divergence, but it's below these lows over here with price above. So that's getting a little bit more sketchy in my opinion. Now I'm going to switch and pull up ES, okay, S&P Futures. So this is a 4-hour chart of ES, S&P Futures. It's doing the same thing right in this same place about mid-April. And you can see it's not just like a relative divergence here, it's starting to lead lower. So this is a completely different asset in terms of the kind of volume that's moving in versus the SPY, but it's showing the same thing, you know, that same signal over here in this kind of lateral range that we've had the last 3 or 4 weeks. So what are the weaknesses in the hands of a new user? How might a new user get in trouble? Like any indicator, if you assume it's a holy grail, if you assume that, you know, it's infallible, you're going to get in trouble. One of the things I see the most is people assume that it's always telling you something. I would say 90% of the time, it's not telling you anything. So don't torture the indicator to try to tell you something. Like if you're really, you know, hot about a particular trade, maybe you want to short, you know, the S&P or something, there can be like a little confirmation bias. You look for the stuff that kind of fits with your other information. So I just always kind of say, don't torture the indicator. If something is there, it may be worth watching, but if something jumps off the chart, like really unusual, like we're starting to see with these leading divergences in some of these charts I just showed you, to me, that's a really actionable, strong signal. So for new users, I would just say, don't assume that it's always telling you something. I would say, assume that it's not telling you something most of the time and wait for those things that really jump off the chart. And to know what those are, you have to spend a little bit of time getting used to it. And that's why generally I only give it out to members because they see it every single day. The next question was, how does someone acquire it? Like I said, I generally don't give it out to people other than members. I don't sell it. I'm not trying to attract members with it. It's just they see it every day. They see how I use it. And it's not like you can jump on Google and say, you know, how do I use 3C? So I've just been a little cautious about that. There's also a case for keeping, you know, proprietary indicators proprietary, just because you know, there's very savvy institutional money out there that front run stuff. How do I use it in my trading? Again, to me, it's not a standalone indicator. It's just a piece of information. And that fits in with all my other information. So if I see probabilities lining up and 3C is doing something really interesting, you know, that may be something that forces me or makes me go into a trade. So the more probabilities, that's what I'm always looking at, is probabilities. Divergences seem to be the most exciting to a lot of people. You know, they see a divergence and they get excited about it, but there's really good information to me in just knowing that it's confirming the price trend. So if you're long or you're short something and I check in on that and it's confirming the price trend, I feel pretty good about staying long that thing, or short, whatever the case may be. What time frame do I use? Mainly that 1 minute, like I showed you. It's just a little bit more sensitive. You see stuff coming faster, earlier. On TOS, sometimes I'll use longer time frames just because their historical data is limited. So like on Stock Finder, I was saying I have almost 2 weeks of data. On TOS, it's like 3 days. So it's hard to see a trend over there. Once in a while, TOS seems to like wig out and give me like 2 or 3 weeks of data. And I've asked them, you know, how do I get this to stick? They're like, we don't know. So I don't know if you guys know anything about that. Next question was, do you use other supporting tools or confirmation of 3C? And if so, yeah, absolutely. So my favorite tool, actually, especially in the last few years, is price action itself. You know, how price moves, whether it's in what kind of consolidation it's in. That is absolutely my favorite indicator. That is, you know, number one for me. But I'm looking at all kinds of different things. Right now, I'm looking at yields a lot. One of the big reasons, like in 2018, I had a really strong feeling that the market was going to sell off. One of the reasons was copper. You know, when copper makes a 10 or 20% dive, that's a really disinflationary signal, and that was happening. But what was really standing out to me was the fact that rates, the 10-year yield, was about to break out to an all-time new high, or a new cycle high, and the Fed was in the middle of that kind of hiking process. And as soon as that 10-year yield broke out, the market sold off. From October to December, S&P lost about 20%. So I look at yields, I look at credit, especially like high yield credit, because a lot of times that's a proxy for S&P futures by institutional traders, because HYG is so liquid, maybe the most liquid asset out there. I look at currencies a lot, commodities, volatility, relative performance, how one thing performs against another. That may be how small caps, a lot of times small caps will lead risk sentiment. So I'll look at small caps compared to the benchmark S&P. And in fact, you know, coming into last week, small caps were leading the market down. And then this week we got that pretty nasty move in the Nasdaq. That 2017 melt up example, and it felt like something was coming because one after another S&P sector negatively diverged. But there was also something else that was really strong. It was a strong VIX positive correlation, a 30-day correlation. This happens like, I don't know, maybe happened 3 times in 20, 25 years or so. A really strong correlation at 30 days over 0.4 is what I use. And that preceded the 2000 top, that preceded the 2007 top over there, you know, the financial crisis. And that preceded that nasty sell-off we got at the beginning of January, January, February of 2018. So that was a big signal for me too, was that positive correlation between VIX and the S&P. So how do you read its structure, meaning the peaks, sharps, bottoms, flats? I've seen some of you guys talking about this stuff. I generally don't, but that doesn't mean it's not useful. I'm always looking at how it moves compared to price. If price is making higher highs, higher lows, is 3C making the higher highs, higher lows, or is it diverging? So
any charts you can throw up as you're talking, Brant, is helpful. And I know you can't, these are on your website, so you can't pull a lot of these up, but.
Yeah, I'll pull a couple up. Let me just look at these last 2 questions, see what they are. What value do you give? Oh, here's another. What value do you give it crossing above or below price? Let me show you this real quick. I don't know how the charts you guys use are working as far as how if they're anchored or not. So I'm going to share this real quick. Okay, so this is just a 1 minute chart of QQQ. I'm going to back out a little bit. So what I want you to kind of watch is where 3C is relative to price over here, just a little bit below. Now, if I change this zoom factor, over here, it's a little bit above. You see how it just moves a little bit differently compared to price. So personally, I don't give that any credibility, but if you have an anchored indicator, it could be useful. I think the thing that people are picking up on when they see 3C cross below price is they're picking up on a divergence, because for it to cross below price, it has to diverge with price. So even though you know, what I'm showing you here with that anchoring can change, I think some people have mentioned that what they're actually seeing is a divergence. Otherwise, 3C would be moving with price. How important is the angle of attack? I wasn't sure what this was about. Is this asking like a leading divergence?
The angle of attack is how how steeply 3C is moving in relation to price.
Yeah.
What you mentioned before, and Kirk uses the term rockets up.
Yeah, it is important. I mean, it's showing you really strong buying when it rockets up like that, or occasionally when it rockets down, you know, you're getting heavy selling under the surface where you don't necessarily see it in prices yet. Prices may not have moved. Yeah, I think that is very useful to be aware of that, to watch for those kind of things. Those are the kinds of signals that, like I was saying, are unusual, that jump off the chart. The last question was, one member noticed on 1 day, 1 minute chart that 3C puts in overnight high and low, that eventually within that day, price will arrive at or near, very near those levels. I haven't studied that, so I can't say. It may be, but I have seen similar things. And I think I pointed out an example last week. I can't remember exactly what it was in, but 3C had negatively diverged from price and it was leading lower. And by the time price caught down, just like we kind of saw with QQQs, price almost reverted right down to where 3C had been at that leading divergence. So I think there's something to that. And I think that is the end of those questions. Let's see. Somebody asked about ETCG. Quite frankly, I only looked at it a couple of times before I got into the trade. Let me pull that up. ETCG is the Ethereum ETF. It was up like 200% this week. And I went out to this 4-hour chart. So what I noticed, I don't know if you can see it over here. It's kind of like a cup and handle right over here. Let's see, when did I get involved in this? I think I got involved in it right over here. But anyway, you can see this kind of cup and handle. And if you look at price, it's going down right here. If you look at 3C, it's moving higher. It's leading higher. This to me looked like an important bottom was forming here. And I just kind of watched this for a while. I'd been in GBTC, the Bitcoin ETF. And as we got some more price structure, I think right in here, this kind of descending wedge, got involved with this on the long side. But, you know, this is kind of one of the first things I looked at when I was considering this trade. And I thought, this looks like, you know, it's a bottom. Let's see what the shorter term chart looks like here. Again, this is why I don't like TOS for these shorter term timeframes, because you just can't get enough history to make sense out of it. But if I back up, now ETCG was up like 200% this week at one point until Friday. It came down a little bit. But if you look at, this is pretty much this week, Monday, Wednesday, Thursday, a lot of times you'll see 3C like right over here leading higher. Prices kind of consolidating. This is a little bullish consolidation. There's no problem with it. And right towards the end of the day, price isn't really doing much. 3C is leading higher, moves higher over here. You can see a positive divergence over here, leads higher over here. Looks really bullish. I mean, look at this, where price is kind of drooping into the end of the day. 3C is still leading higher. I stayed long this, but I was starting to get a little nervous because it started to look a little parabolic, hadn't consolidated a lot. And here's into Friday. So 3C to me looked very strong right up until Friday. And you can see at the open over here, it's starting to negatively diverge. And I'll just kind of walk this forward a little bit. Now, prices made significantly higher highs, right? But if we just follow these tops of 3C, they're all making lower highs into this Friday high. And I think, what was ETCG down on Friday? It was down 37% on Friday. It was up 90% on the week, but it had been up 200%. So unfortunately, like I said, there's just not enough scaling to put this all on one chart on TOS. But you can see it go from a constructive, either leading or tracking with price, to right here, the first kind of sign of some trouble. And as prices continue to advance, 3C is no longer confirming. It's not making higher highs, it's making lower highs. And that doesn't necessarily, sometimes that will mean, that price will move into a consolidation, but it always makes me alert and aware of the potential, especially in this case where it almost started going parabolic, that it was no longer building in that nice structure. Let me see if I can just pull that up real quick. Did anybody trade ETCG?
I'm in it.
I
Yeah,
didn't
I'm
know
in
it.
it. I'm in Bitcoin.
Yeah.
I didn't know it existed.
Yeah, it's just that there's another one, ETHE. So anyway, this is kind of where it looked like a bottom was coming together. We have the nice ascending triangle base here. What is it, almost 4 months, a descending wedge here. I think this is where I got involved, either right here when it broke out or right over here. But in any case, if we take like a little closer look, it was really trading really well. And like I said, price action is my favorite indicator. We have a little bullish pennant or a little bullish wedge here, a little bullish flag over here. And my measured move target this week, coming out of this bull flag, just the measured move, is from here to up here. So I was looking for a measured move of 40. And this is kind of where I would expect price to just stop and consolidate, put in this next consolidation. And instead, it just started getting parabolic. It was up between 25 and 40% for 4 days in a row every day. And yeah, that made me a little bit more nervous. And I started talking about that, like, it's great that it's parabolic, it's making these big moves, but be aware that it can come down real fast. And like I said, we saw that a little bit on that chart, 3C chart. The higher it moved past this measured move over 40, the less 3C was confirming. So it's kind of like maybe dumb money is coming in and chasing it. The Reddit traders see it moving, they're coming in and chasing it. But that real strong institutional flow that's supporting price is not there anymore. And what scares me about it is that we have this big move above 40 with no consolidation, no support built in until, we get down here to 31 something. So I think that sums up those questions that were on the list, if anybody wants to chime in at this point.
Yeah, I have a few, if you don't mind.
Sure.
This is Mark, by the way, Brant. Nice to meet you.
Nice to meet you.
Same here. So how you talked a lot about price action. So how does Triple C correlate or confirm like the advanced decline or the vol D?
The advanced decline as in like market breadth?
Yeah. Yeah, market moves on advancers and decliners.
That's interesting. I had just seen a chart about that. Let me see if I can find it real quick.
While you're looking for that, what platforms can use your Triple C?
Warden platforms, because that's where the proprietary indicator is. So StockFinder is an old platform that they're really not even servicing anymore. They're not really doing anything new with it, but I like it because it's got, I think I can get 5,000 bars of historical data, and that's what I like. I also use Warden's TC2000. I use that. I just like the drawing tools in there for, annoting charts and stuff. I use TOS. So basically, any Warden platform and TOS have a version of it for TOS. So let me show you something real quick. So this is the S&P 500 in the candlesticks, and this is the Nasdaq 100 advanced decline line. One of the things I noticed was that 3C was negatively diverging in QQQ. Let me just back this out. Again, this is a chart I've showed you a couple times, right over in here. And if you look at that advanced decline line, it's doing the same kind of thing. So they're not correlated in any way. There's no commonality between them, but they're kind of saying the same thing. if that makes any sense. 3C is
Mhm.
not at all correlated or constructed on advanced decline stuff. So, or
No, it's good that
internals.
it's not correlated. But if it's confirming the same type of
Yeah, it's
direction,
confirming that
that's-
kind of weakness in those larger cap stocks. This is Nasdaq 100's. Actually, this is Nasdaq 100's advanced decline line. So it's confirming that same kind of weakness. And again, like Kirk, if you read all the updates, so I was really harping on, yeah, QQQ looks like the one that is in potentially the most trouble, especially if rates move a little bit higher, yields move a little bit higher. This week, yields didn't move higher, but every economic data point was inflationary. The way commodities moved was inflationary, and it was picking up on that.
Right.
So it is interesting, that 3C looks similar in divergence to an actual breadth indicator of the Nasdaq 100 here. And what was the other question you asked about?
So
and
the last-
volatility.
yeah, the advances and declines and the volatility were the three.
Yeah. I love, like, if I see a strong signal in SPY, I love looking at volatility, whether it be VXX or Vix Futures, and getting the opposite confirming signal. So if there's a positive divergence in SPY, and then I see a negative divergence in VIX or vice versa, to me, that is a form of confirmation.
Okay.
And I'll do that with S&P sectors. I'll look at S&P sectors, especially the ones that are important right now, which is pretty much the cyclicals and the like mega cap heavy sectors like tech, discretionary, and communications.
Can you pull
Okay.
up a volatility index with 3C on it, Brent?
Yeah.
Thank you.
Volatility has been everywhere recently. We have kind of a trend of relative strength. I wish I could show more data. Again, this is as long as it gets, but it's a lot longer than TOS. Again, the S&P kind of went into that flat range, and it was negatively diverging right before that. VXX, again, kind of a similar flat range. It positively diverged right before that. So that is, to me, a form of confirmation, because the S&P is doing the exact opposite thing right before it moves into a lateral range. And VIX is doing the opposite with a positive divergence. SPY negative, VIX positive.
Can you overlay the SPY over that in addition to what you have there or not?
I can pull up the SPY. Let's see where this is, where this divergence. It's about mid-April over here, where it starts pulling into this divergence and price starts moving sideways. So again, this is a good example of just because there's a divergence doesn't necessarily mean price is going to go from down to up. Price moves in three directions: down, up, and sideways. A lot of the times, if the divergence isn't really leading, it's kind of a relative divergence. A lot of times, you'll move into a consolidation like this, or a range, kind of this zone that you see over here. And of course, this is Friday, as risk-free Fridays volatility gets hammered. So let's pull up SPY real quick. We can do it on this 5-minute chart. Again, this is kind of where it goes from confirming with price to starting to not confirm. Again, that's about, mid-April. And you get this range over here. So a little bit of improvement, on Thursday, Friday. I think a lot of that is short covering, those big tech stocks. So does that make some sense?
Yes.
Yeah.
So with this chart, leads my last question, which is, and I'm sorry to take over the room, but I'm relatively new to this triple C. So what time frame is the best one? I know you said that we just have to test out each of the time frames, but I'm more of a scalper than a long-term holder or day trader. And so, looking at this 5-minute chart, you don't see the slope until later on, right?
Yeah, the longer term the chart is, generally speaking, the more important the trend is, but the less sensitive it is to like minor deviations. Like if you're day trading, it's going to be less sensitive to that. So I've used 3C in tick, in like 800 ticks, 1,000 ticks, whatever, you can use it in that. What time frame do you generally look at your charts on?
I trade off the 1 minute chart, but my entry is through the 25 tick.
Okay, so you could absolutely use a 1 minute chart of, what are you trading, like ES or SPY or something?
Primarily NQ, but I also use ES.
Yeah.
Futures. Yeah.
Yeah, so I would say go with that 1 minute chart, get used to how it looks, how it feels, how it acts, and look for those signals that jump off. So, when I see something like this, let's say on this 5 minute chart, let's say I was long the S&P 500. And by the way, this was like a really major oversold low over here, like ridiculously oversold, almost as oversold as the crash last year. It was crazy how oversold it was and price hadn't moved that much. So what this would tell me, if I was long here in SPY, this would tell me either get ready to put in some stops and trailing stops because something is changing. That doesn't necessarily mean price is going down, but I don't want to sit in the S&P for 4 weeks in a 1.7% high to low range. It's just, it's not something that's attractive to me. But you see that and you might say, hey, I can scalp this range. I know this range is here right now. I can scalp inside this range. I kind of have my, the low end of the range, the high end of the range, and the indicator is telling me that the probability is that it's going to move from up to either sideways or down. So you can use that, kind of maybe look at that over the weekend. Maybe you do some of your analysis over the weekend. You might look at some of these longer term charts just to get kind of like the background of what price is doing, and then figure out how you want to trade within that on those shorter time frames. But absolutely, you can use 1 minute chart is what I use almost all day. I have used the tick charts, and it's all the same concept.
Okay, thank you.
Sure.
So what is the membership?
Oh, for my website?
Yeah. And
Yeah.
for use of your indicator.
Oh, if you're trading with these guys, I don't mind, letting you use it, giving it to you. I would just ask you don't share it with other people. My concern is just giving it to somebody who doesn't have like resources to, ask questions to somebody. Like, you can ask questions, I'm sure, to Kirk or Art and say, hey, what is this going on here? But that's really kind of the only reason I don't make it available publicly. So it's not like you have to become a member to get it. But I feel, you're in this room with them, you're seeing how they're using it. I don't have any problem with that.
Oh, thank you very much.
Yeah,
All
sure.
right, that's it for my questions. I sorry guys for taking so long on this, but I really appreciate, all the presentation. That's excellent. Thank you.
Oh, thank you, Mark.
I appreciate your questions, Mark.
Yeah.
This is James. I have questions if no one else wants to jump in.
Sure.
If you could go back to your QQQ chart
Sure.
with the 3C. And my first question, though, the 3C we're seeing, what are the settings on that? I know that
Good question.
Yeah, this is the one I almost always use. I'll pull it up over here.
I'm on TOS, so I have your 3C. If you don't remember me, I had a big long session with you a long time ago, and I have the settings. We have a 1031-1 and then a 2052-1, and I'm wondering if you would address which one you use most and what they tell you, how they.
I use the 2052 the most, which is that orange one.
Mm-hmm.
So what that 2 is, like earlier I showed you TSV, the real TSV, and to get a usable signal, you have to average it, usually at least 18 bars. Some people go up to like 28, 38. And that's the way you kind of get that information to plot on a chart. So what I've done over here is, instead of using TSV average, I took out that average. There's only a 2-bar average on it. That's just to smooth it a teeny bit. That's to keep as much of the pure data, because when you average data, you lose data. And then these are kind of look back periods. This 20-bar look back, 50-bar look back. So it's kind of looking back saying, okay, what is the indicator doing here versus X bars ago? And if it's doing this, then it ticks up. If it's doing that, then it ticks down. So I just like, I mean, it's kind of a strange setting, the 2050, but years ago, I went through a whole bunch of different ones. And to me, this was just the most useful. It had insights a little bit faster than some of the other ones. But like I said, you know, this isn't an indicator that's been out in the public domain. So a lot of people are experimenting with it, and there's nothing wrong with that. I encourage people to make it your own. You know, how everybody's mind works differently. Like I said, I have kind of a skeptical eye. Things that, you know, that are obvious to me don't stand out, like an uptrend. It's just obvious. It doesn't stand out. But when high yield credit, you know, drops or diverges from the S&P, that, you know, makes the hair on my neck stand up. I look for stuff like that. How commodities are trading. So if we went back to January of 2020, commodities were sending a huge disinflationary signal. I mean, when crude and copper dropped 10 and 20%, that's a major macro signal going on. And the S&P was at all-time new highs. Then you had yields doing the exact same thing, dropping almost in tandem with those commodities. So again, it was just a lot of different things coming together. There was also 3C signals coming together. You could see that the flows were getting weaker, market breadth was getting weaker. I think I had been kind of warning about that crash coming for about 5 weeks, especially like on YouTube. I did videos like every weekend, like, okay, look at this, this is not good. And more so on the website. I'm sorry.
Can you, one, I'd like to take you back to the 1 minute QQQ chart that you've been using with your 3C on it, sure, to the April timeframe, April 26th, 7th area, 5th,
yeah, right
and
in
the 3rd.
here.
Okay,
Yeah.
So my question to you is this. There are, most of the people that you're talking to are day traders. They're done. You know, most of them are done by 10 o'clock Eastern time. There are a handful of us who trade options. And so my questions are geared towards 3C and its use for options trading, either, you know, like a swing trade where you're maybe buying them 2 or 3 weeks out to expiration or longer, and or short-term trading where you're just going to hold it, maybe enter the options trade towards the end of the day and see what happens the next day, that kind of thing. So I'm wondering if there's a use for that. But the reason I wanted to take you here on this chart, did you personally, or did you in your website post any type of options trade when this divergence happened and then confirmed itself on the 27th when that lower high came in on 3C and then just broke down? Did you yourself take a trade? If so, what did you do? And did you put anything in your website of a trade to take? I went and looked at the QQQ. The reason I'm asking, I looked at the Qs on that day of the 27th. The Qs puts, the 340 puts were going for 238, and they peaked out at $13.28 on the 4th and 6th of May. So
to answer your question, I have like a really diverse group of subscribers. Mm-hmm. Some are novices, some are day traders, some are swing traders, some are longtime investors. I have a couple that are fund managers. I have one that is like a financial author or financial news analyst, something like that. So I have a diverse group. And early on, I was doing a lot of stuff more with trades. And what I found was I could give the exact same trade to 10 different people and walk them through the whole thing. And there'd be 10 different results, and ranging from losses to wins. I mean, it was crazy. It's just because, you know, people look at the market differently. People trade the market differently. They have different risk tolerances. So what I try to do is put out as much information and put it in context so that they can use that for their own trading style. I think it's not important at all, what trading system you use. What's important is that the trading system you use is a good fit for you, the way your mind works, the way you analyze things, your risk tolerance. So you see people a lot of times jumping back and forth between trading systems, jumping back and forth between indicators. They're looking for that magic bullet or something, where I think it's much more important to find what works for you. And a good way of doing that, in my opinion, is to keep a journal and write down everything, why you got into the trade. If you were having a crappy day that morning, if you had a fight with your girlfriend or your wife, whatever, anything that could influence that trade, and then just let it go. Go through that, do that a couple months, and then go back and reread it. And you'll see patterns in your trading. You'll see things where you did really good and you always do good. You'll see things where you did really bad and you always do bad. So you can say, yeah, I'm going to avoid those trades, or I'm going to work on this, or yeah, this works really good for me. So when I see these setups, that's a good way. And the point I was getting to was really spending some time, not jumping around, but spending some time with the indicators that you like in the time frames that you like, and just getting to know those, I think, is much more important than what you put on the chart. Let me see if I can pull up the afternoon update from that Friday, from last, not yesterday, but the Friday before. This is just kind of like a real quick, I'm going to try to share this, just like a real quick summary at the end of the day. So can you guys see?
Yes.
The afternoon update, April 30th.
Mm-hmm.
So here's that range I was talking about, and that kind of head fake there above it. So like I was talking about earlier, small caps tend to lead risk sentiment, at least. Okay, so one notable change from last week is that small caps came into the week leading higher over here where it's green. This is small caps in blue versus the S&P. They came into the week leading higher. They exited the week starting to lead lower. So to me, this told me, next week, this past week, the risks to the downside were a lot greater. So these wider 3-week ranges are in play, and we may have just seen a bull trap right over here in red. In Nasdaq, that was the case. These can often lead to fast reversals, and what we saw with Nasdaq was it just broke through the bottom of this range. I kind of expected it would move to the bottom of the range. It just sliced right through it Monday morning. Here's Nasdaq. Here's that kind of little false breakout or head fake, whatever you want to call it. So on the week, okay, so we get to the wrap up of this. I think the biggest development this week is the breakout in bond yields. This correlates to, Nasdaq, because Nasdaq has been having a lot of trouble with rising bond yields because of the valuations. So this is the copper gold ratio real quick in red, and this is the 10-year yield. This is a signal from commodities. It's like a macro signal from commodities. It's very, very inflationary. You can see like a little bull flag here in that ratio. This broke out a week before yields started to break out of a similar bull flag. So if we just go by the historical levels here, this copper gold ratio is suggesting that the 10-year yield should be up around 2.9 to 3%, almost double what it is now. It moves 10, 15 basis points up, and Nasdaq sells off, tech stocks sell off. So if it doubles and you're talking about 100 basis points up, imagine that. And that's what the copper gold ratio is saying right now. So that's one of the reasons. And here you can see the breakout. This was not yesterday, the Friday previous. So here's the breakout in the copper gold ratio. That was the week before. And here's the 10-year yield following it breaking out from a similar little bull flag over here. So again, things I watch. So the wrap up was, although small caps are weakening at a faster clip into the end of the week, they probably find some brief technical support next week. I expect it's Nasdaq 100 that will get hit the hardest on any rise in bond yields. And recall that the mega cap, large cap tech stocks were rotated into this month, the start of Q2, so that could be some trouble. And Nasdaq was the one that got hit this week, but rates didn't go up, yields didn't go up, but we had really inflationary data, the ISM, manufacturing and services, both really inflationary or stagflationary. Commodities, wood, copper, all these things sending really inflationary signals. So traders are noticing that, whether or not yields are moving as you would expect. So earnings season will continue. As I've mentioned several times, it's usually a flat time for markets with a slight upward drift. That's what we've seen the last 3 weeks with large ranges in S&P and Nasdaq. Other than day-to-day earnings volatility that's unpredictable, I think the path of least resistance over the next few weeks is down. Earnings season and range lows will likely keep it choppy. So I'm not expecting a smooth decline sharply lower, but more of a messy, choppy hit and run environment until or unless we solidly break below those ranges and technical levels. So Nasdaq did break below that range. However, rising yields, which I've expected and now we are seeing, have been and should continue to be a problem for large cap tech valuations, Nasdaq 100 stocks. A rising dollar would be another net negative for equities across the board. I talked a little bit about sticking with ETCG. That was up almost 200% this week. So it was just looking real good. So yeah, I mean, you're seeing one snapshot of the end of the day on Friday, but through my daily wraps and through intraday updates all throughout the week, that theme of Nasdaq looking weaker was, just a dominant theme. Did that address your question?
My last two questions are, one, you mentioned the VIX 30-day and you said something about 0.4. Could you elaborate and illustrate that? And number two, last question is, do you pay attention to the equal weighted indexes?
Yeah, I do. That's in terms of relative performance, relative strength, I do. So, if you see the Nasdaq 100 up and you see the Nasdaq equal weighted index down, the probabilities are that the mega caps are leading the charge, where the majority of other stocks are kind of drifting lower. And that's something we've been seeing really for a long time, a couple months anyway. Market breadth has been getting weaker. So one of the concerns I would have is, you have the S&P and Dow that just broke out of these ranges. They're at new highs, but you have those mega cap stocks that haven't done the same yet. And you've kind of been relying on this pro-cyclical trade of like energy and financials and industrials and stuff to support the market, but then it's been wavering the last, month. There's been rotation out of it at the start of Q2. So they rotated out of those cyclicals, went into the mega caps. But the point I'm getting at is if you don't have the vast majority of stocks supporting the index and you have only a handful of these mega caps, and then suddenly rates move up a little bit, they're going to get crushed, and you don't have that broad support of all those other stocks, to hold up the market. And that's where you get big downdrafts. So let me see if I can pull up that VIX study real quick. And you can use a 10-bar correlation too with VIX and S&P, and that a lot of times will pull up just pivots, but the 30-bar tends to be really strong signals. Let me see if I get this right here, and then I'll pull it up.
30-bar, you're talking looking at VIX over 30 days. Is that what you mean?
Well, it's a 30-bar correlation to the S&P 500. Okay, can you see that? Should be a black TOS screen with white indicator on the bottom.
Yep, got it.
Oh, so you're talking VIX Futures. Okay.
You can use VIX and SPX.
Yeah.
I mean, you'll get a very similar signal. So down here, this is a 30-bar correlation of VIX to the S&P. So if you looked at, this is that 2017 period I was telling you about, that melt up into early 2018, where one S&P sector after another started negatively diverging, and we had this huge spike in positive correlation. So if you look at VIX at the end of 2017, it's actually tracking up with the S&P with price. So you get this positive 30-day correlation. Generally speaking, it should be negative. It should be down here at 100. So this positive correlation, and over here it's above about 40, is about the signal area. You only see this before like major tops. And this was, at the time, a big sell-off in January of February 2018. You can see another one here. It's not quite as high, but we got, a little dip. Even when it's moving up over here, it's showing a stronger positive correlation. And let me see if I can move back. So some smaller ones here, they're not over even 20.
Where's 2002?
Yeah, here's oh, what happened to data there? There's 2007. That
Yeah.
one is just about 40, generally above 40. Let me try to show you a 10 bar setting real quick. So this, why I've got it here, this is a 10 bar correlation between VIX futures and S&P futures. So you can see, you know, it peaked up here right before the sell-off. What was this? I think 15% sell-off or something at the time. Again, start seeing it over here before this decline, which was about a 20% sell-off in the S&P at October to December. And again, we saw it right over here. Again, this is a 10 bar, so it's more of like usually a trading kind of signal. You know, something's up. You see it again over here. Over here, but let me go back to that 30 because that's the one that.
So
really
when you say 10 bar is trading, you mean for shorter term trades or?
Well, it's just an unusual signal that
Yeah,
typically means something is coming when volatility, and you might notice it first, like in the day, you might notice the S&P is up 0.5% and VIX is up 1%. You know, that's not normal.
Okay.
That's a little bit of relative strength. You might notice that the next day, and maybe 2 days later, and then I would pull up an indicator like this and make it easy for you to see.
Okay.
Or you know, plot VIX with the S&P, and you can see them moving together. I can show you examples of that. But I'm going to go back to this 30 to get to that original thing we talked about. And this is just a correlation indicator that you can pull up on TOS.
Right.
And over here, you can see, you know, like 25. I like about 40, above 40 or higher. So that's that January, February, early 2018 sell-off. Hopefully we can get
above 40 or higher, it's back the truck up and
it's something nasty's coming, because this has only happened a few times.
And load up on the puts.
Yeah, I mean, here you can see it's below 20, you know, so it's not one of those really strong signals. But I don't know why there's data missing right here in 2007, but there was 1 or 2 signals right here at that top 2007. This is in that 40 range right there.
Yeah.
And then I think we can get back to 2000. Might even be able to get back to the, you know what? Maybe it's sick. Maybe it's a tick. Let me change it to S&P and VIX. Okay, so there it is, 2018. Keep in mind too, VIX was reworked. What was it, 2003, from the SPX 100 to the 500. So here's that 0.4 reading, about 4.6. This is the 2007 top. That's the financial crisis. That's the 2009 low.
What a beautiful signal, man.
Yeah, and then we go back, nothing, right? Nothing significant. Yeah. And here we are, 2000 right there.
Holy
That's 0.42. So the longer the period, the lower the signal is going to be. So if I put in a 10-day correlation, that signal might pop up to 60 or 70%. But because it's being averaged, the longer it is, it's not going to get up into the 70s or 80s, anything like that. I think we can go back even further. I think there was one before the Russian financial crisis. Yeah, over here, the Asian financial crisis. I think there was even one before 1987's crash. Where are we? 1990. It gets a lot crazier here, but there's 87's crash.
Wow.
Hit 84 at the high. So this means as the market was making these new highs, that VIX was trading up. It was trading higher instead of moving down. Volatility generally moves opposite. So these are really unusual signals. Back here, you saw a lot more of them than around 2000. It kind of changed a little bit, got a little bit cleaner, less of them. But that's the 1987 crash right there. There's a big one right before that. But like I said, you can use the 10 bar for just kind of like trading pivots. A lot of times when you see that 10 bar kind of go positive, there's a pretty good chance that you're going to have a pivot, like a downside pivot.
Well, that's going to become a permanent part of my charting on TOS back on their pairs tab, where it has the correlation part built in, and I'll change it to a histogram instead of a line.
Yeah, I'm going to see real quick if I can just pull up a visual example.
James, thank you for this question. This is very fascinating.
Those are retirement trades. I mean,
absolutely. Now,
somebody knows something's going on when that's happening. Somebody knows something's coming. They're hedging up. You know, because there was only 3 of them in 20 years, and they were all before major tops. So that was one of the things, again, in late 2017, early 2018, that stood out. Okay, let me just see if I can get enough history to back this up to, yeah, I can.
Option traders, take note of that chart setting. You only have to look at it once a day.
I don't know how easy this is going to be to see, but we'll try. So this is that 2017 run up, melt up.
Yep.
And this is Vix here. God. It's not a great, the scaling is not great here, but you can see Vix making higher lows over here, trending up with price until, you know, volatility just exploded. What was that ETF that went kaput? There was a volatility ETF that just blew up.
TVIX, I think it was.
That's right. That's right. Yeah, just blew up. Just blew up. I mean, everybody was shorting volatility. It was like nothing can ever go wrong. It's just a guaranteed income. And you see strange stuff like this happening. You know, I don't know if I just the bars, maybe it will look cool. Yeah, but you can see, you know, this trend here. You can draw a trend line. That should not be happening 1 or 2 days, much less almost a month. And you know what? The same thing happened in 2007. So if we go back, hopefully I can get back that far. Yeah, really good example.
Wow.
So here's the 2007 top. Look at VIX, what it's doing here. It's trending up. So this is that relative strength on a so you're looking at a 30 bar correlation or 30-day correlation. And it's just that signal that pops out above 40 is telling you that this is happening. You know, and that shouldn't be happening. VIX should be going the opposite way of the S&P. It's tracking up with it. So unusual stuff with volatility, you know, that's some of the things I like to look for too.
So how do you hang in a trade like that? You can't do it with options because the time decay will kill you. So do you use the ETFs? Yeah,
ETFs or sometimes the leveraged ETFs, which, you know, can be problematic, but something where I can sit in with some duration on the trade. So generally I have to give up a little bit of leverage, but then when I see something like an initial break and a bear flag, then I'll kind of jump in with more leverage and maybe put some options in, because I know the probabilities of a second leg, you know, if the first leg was 8% down, the second leg is generally going to be another 8% down. So I can figure out that's a much higher probability once we get a break and we get a bear flag, and I can leverage up that way and use options. Does that make sense?
Yeah. Yeah. What's for the Qs and the SPYs, what are your favorite inverse?
I'm not, to me, it doesn't matter that much. I'll use SPXU or something like that, you know.
All right.
SQQ. I can show you one other thing on volatility if you guys are interested with the absolute breadth index. Kirk, you've probably heard about that, right, on the site?
Yeah.
So this is a breadth index, and if you guys are interested, I can probably find some posts I did on this that lay out like some back testing and stuff. But it's a breadth index. It has nothing to do with, you know, money flows or anything like that. Let's see if I can pull it up here. And what happens is when this absolute breadth index, and just fair warning, if you pull this up on a different site like stockcharts.com or something, the values will be different. Warden just calculates it differently, but the concept is when it makes extreme lows, and for me in back testing that means under 15. Here it is in white. So this is the SP 500. This is the absolute breadth index. When it makes extreme lows, and the lower that low is, there's a really high probability that volatility is going to see like a double-digit percentage gain over the next month. Sometimes it's the next day, sometimes it's 3 days, but generally up to about a month. And let's see, the last one we got over here, I think was just didn't quite make it to 15. Over here, didn't quite make it to 15, but where's my pointer? I didn't quite make it below 15. So this was last week. This week, it went down to 13. So this for me is a long volatility signal and suggests that over the next month, we're going to see a pretty big move in VIX. See if I can pull this on a daily chart. So you don't get too many of these really low signals below 15.
So,
but over here, you got one right before this sell-off here in 2020, in the start of 2020, you got one of these signals and volatility jumped to what? VIX jumped 600% or something.
so what's the trade besides shorting the indexes? Would you buy UVXY or options and VIX?
So you could do, VIX futures, you could do options in VIX, but generally speaking, the ETFs like VXX are going to move as quick. Where you have an advantage with them is if volatility's term structure has gone from contango into backwardation, and it's actually in backwardation. The longer it's in backwardation, the more VXX will start outperforming VIX, at least in terms of trends. So VXX will still make higher highs while maybe VIX is already topped and is starting to make lower highs. But again, the longer it's in backwardation, the more beneficial it is for those kind of ETFs like VXX or UVXY. And I'll just show you real quick.
So that means like your shorter term, the 9-day VIX, the 30-day.
Yeah, you're thinking about it right.
60-day are higher than the 1 year and the 9 month and the 6 month VIX.
Okay, so here is the S&P 500 on daily chart. This is my kind of approximation of term structure here. And when it is above 1 over here, it's in backwardation.
Okay.
And generally speaking, that's pretty extreme point in the market, and often you will get a pivot low at some point rather quickly. You can see over here and here, but the longer that this is in backwardation, the more VXX's price trend will perform better relative to VIX. Well, that about these ETFs, that contango kills them over a longer period of time. So it just kind of stands the opposite. When they go into backwardation, it benefits them, or when term structure goes into backwardation.
Have you been able to create that volatility term structure for TOS?
You could. All you need to do is pull up a either difference or relative performance indicator. I did this one so long ago, I can't remember what I used. I think I might have used like 30, 3 month over here, VIX versus 3 month, VIX 3M. But anyway, you can use relative strength, the indicator that compares one asset to another, or if you have difference, you can use that as well. But relative strength is a real easy way to do it. So I know that they have that on TOS. I could probably work it out over the weekend and send it to Kirk or whatever if you guys want to.
That'd be really nice.
Yeah, I'd like to do that too. Yeah.
Yeah, when you get over, 1, basically you're into that backwardation. But like I said, that also means you're in a really, really extreme market. But it went on over here for almost 3 weeks during that 2020 crash.
But from a practical, if you'll stay where you are, from a practical trading point of view, it first touches, if you're on February of 2019, then February of 2019, and in January 2019, it first touches a 1 right to your right. It hits it one time, comes down, hits it a second time, a third time. This
was insiders getting out, by the way. Like those Congress people, Senate people, they had gotten briefings. I think the S&P dipped like 3%. Those were insiders getting out on that information.
So
before it made the new high.
In your trading, would you, when you see that first touch of the one, would you put a pilot position on, or would you wait for the over a little further where those bars turn white?
So what I like, I'm not sure if I can find an example of this recently, maybe. Let me just reload this, clean this up.
And we have a global disclosure statement that covers all this stuff. We know you're not giving trading advice. That's why I ask. But anyhow.
Yeah, I try not to, because like I said, you know.
No, that's why I'm asking what
people.
I'm not asking you what I should do. I'm asking you what you do.
Yeah. So what I generally check first thing in the morning when I wake up is, let me see if I can find an example of this. I think this was one here. Yeah. So what I look for is unusual stuff. So several Mondays, the first thing that happened was the S&P gapped up a little bit, like over here. And this is flattening towards backwardation when it's rising. Okay. What should happen when the S&P gaps up is it should go down. So that stands out to me as unusual. That's a little bit of kind of unusual, I guess, more aggressive hedging in volatility that you can see in the pricing structure. So that stands out to me as unusual. And I think on this day too, VVIX was showing relative strength, VIX was showing relative strength. And, you know, you look at what happened after this, we got into this, I think this was like a 0.5% high to low range for a week, you know, just a really flat range. So it was basically telling us that something was changing, something was different. But over here, you can see this is generally how it works. This will go up, this will come down towards contango. That's normal. But when price moves up and this moves up, that's abnormal. And that's just telling me that something's going on with volatility. I start checking out, you know, VIX's relative strength a little bit more compared to the S&P. I look at VVIX. Sometimes it leads to nothing. You know, sometimes if you see this over a pattern of 3, 4, 5 days, those are more significant signals. And I've seen those before market sell-offs. The 2018 was a good example that happened. But you could really see it on intraday charts. I think we'd really have to dissect this. But here is the S&P moving up into that record high into early 2018. And this is term structure flattening. It shouldn't be doing that. I mean, when price comes down, yeah, it spikes like this. But when price is moving up, same as VIX, it should not be doing this. It should be going down.
Mm-hmm.
So again, on this indicator, that is moving up is moving towards backwardation, moving down is towards contango. But you can set it up any way you like, you know, whatever makes sense to you.
Well, I'll look forward to getting your weekend work from Kirk, but I would love to have that on TOS. That's fantastic, man. What a forward lead, you know, a forecasting.
Yeah, well, volatility can tell you a lot, you know.
Mm-hmm.
It's one of my favorite things. I'm sad that, you know, it's been crushed as much as it has over the last 10 years with what the Fed's been doing and injecting money into the market. But I remember like back in 2000, something like that, you could almost trade like if VIX was like above 30, you know, it was time to buy. If VIX went below 20, it was time to sell. You know, it was just like clockwork. It worked so easily. And then everything just changed the more money the Fed dumped into the market. And really, you know, the whole market has changed a lot. If you go back to 1915 to like 1930, all these price patterns that we recognize today, like flags and triangles and head and shoulders tops, they all came from back then. And you go through a chart of like a year and you can see like almost every single one of those patterns in the course of a year. The markets just traded more naturally. They traded with more volatility. They traded the way they're supposed to trade, you know, not being suppressed by, you know, tons and trillions of dollars of stimulus and Federal Reserve, you know, squashing interest rates and all that stuff. So I think for a lot of indicators, it has gotten harder because the money just kind of flows in a tide now. Whereas, you know, in the 1950s, the institutional money was half of what it is now. So it was easier to see things, especially with like money flow indicators. It was easier to pick up on underlying activity, maybe inside information kind of stuff. But now the market's just awash of money, so you adjust.
Can you not just use that paradigm and trade with it? You know what I'm saying?
Sure, you can, absolutely. I mean, that whole buy the dip trade has been,
right,
for the last decade has been the mantra of the market, but if you're like a long-term investor, I think it's good to take like a weekend once a month and look at kind of the macro signals. And when I'm talking about those, it's like, what are commodities doing? What's copper doing? What's copper doing relative to gold? What's crude oil doing? And then our rates, our yields kind of doing the same thing, So like I said, before that 2018 market sell-off, copper plunged. I mean, it wasn't like a small dip. It was like a plunge, 10, 15, 20%, something like that. Did the same thing right before the 2020 crash. Crude did the same thing. When crude drops more than 10% quickly, that's a macro signal. That's telling you something is really disinflationary coming. And then when yields are doing the same thing, it's almost a home run. It's just so hard to ignore. I wonder, I could probably, let me try to pull this up real quick. Just do like a proxy.
Have you ever seen copper give a bad signal? I mean, a false signal? It just seems to be so consistent.
Nothing's infallible, but
Right.
it's like the more of those kind of things you can put together, the more evidence you get. It's all probabilities, I mean, when you're putting on a trade, you're looking for the strongest probabilities. So the more of those things you can pull together, we'll use USO for oil. And can you guys see this chart I'm putting together here?
Yeah, you betcha. Thank you.
And then we'll add the 30-year yield. And we'll make this yellow. So we got copper in orange, we got crude in blue, and the 30-year yield in yellow, and then the S&P in the candlesticks. Just try to get this overlaid here. And what I'm going to do is back this up. Let me go to a daily chart. I know that looks like a mess, but just give it a second. Scaling is really wacky here. Let's go back to the 2018 sell-off. Sorry, kind of messy, but so here's the S&P making these new highs. Look at what copper is doing. It just plunges. This is not normal. Over here, it's doing well. It's leading the market higher. Over here, this plunge, I can't remember how much it was. I think, give me just a second. I'll give you an idea. But generally speaking, when you get like a 10 to 20% plunge, yeah, that was like 24%.
Look at copper leading over in July too. July, August, September to the left.
Yeah, leading higher, right?
Yeah.
Right. Now, it was much more interesting because it wasn't just one signal coming into this crash, COVID crash.
Wow.
So if I get scaled up right, you can see what's happening here. I mean, you've got 10 to 20% declines in crude, in copper, and then yields. This is all screaming deflation as S&P's trading at a record high. And then we just step forward a couple of days and boom.
That's a load the boat short right up there.
Yeah. And this is why I was like screaming about it for almost 5 weeks, because one after another of these things kept happening. And it was like, these macro signals, like I was saying, if you're an investor, it probably pays to check on this kind of stuff like once a month if you have like a portfolio to hedge or to, whatever you want to do. But I really like having that macro background because these are just completely different than technical indicators. The price action of different assets and how they correlate. You can see all of them. I mean, rates, copper, crude, all doing the same thing, stocks ignoring it.
Where are we now, Brent?
Inflationary, which is the risk to Nasdaq. This is probably not great scaling, but yeah, I mean, copper is, I think, the highest since 2011. Some wood is sailing higher. The only thing that really hasn't caught up is yields so far. But like I showed you that last chart.
But the Feds have their thumb on the scale on that.
Well, the Fed can control. Yeah, right. They can control the short term, but generally, you get in the 20, 30 year, they have less control over that unless they're really going to target yield curves, which, may be coming. But I think the Fed is saying, it's transitory inflation. And I think the market is saying something way different.
Question though, in your experience, I have never really paid attention to what happens to the Nasdaq when interest rates go up. Is that just a transition period, and then once the market gets accustomed to the higher rates, then the Nasdaq turns around and goes its way, or is this a long-term crushing of the Nasdaq if you had that spike in yields in the 10-year and 30-year that you're talking about?
It depends on to what degree, because most of those Nasdaq stocks are relying, their valuations are based on future earnings. So if rates move up, you have to discount that. So that's why. And I wish I had a chart available real quick, but if you see the valuations now, depending on what metric you use, they're either at all-time record highs, and I mean like way above anything even close, or they're trading really, really high. I mean even the Fed in their financial stability report this week had to mention that. So the risk really is that they've really priced these to perfection. So anything that kind of jostles that, like higher rates, a stronger dollar, which I'm not sure we're going to get, when you're looking at the kind of things we're looking at, but higher rates definitely hit those tech stocks first, those mega cap tech stocks, especially, or large cap tech stocks. And the stuff that tends to do better is the value cyclicals like energy, financials, industrials to like some degree, material sector, commodities. They tend to tolerate that higher rate because it's saying, growth is moving up, economic growth is moving up. But when you combine that with the Fed dumping trillions of dollars into the markets, which is where it basically goes, and then the government dumping trillions of dollars into people's pockets, which is going into the markets through, Robinhood apps, that creates a scenario where it's very ripe for a big, big inflationary move. And all the economic data recently has been coming in very, very inflationary. So those cyclical sectors like materials, energy, financials, industrials, they'll tolerate higher rates better than technology, communications, and consumer discretionary. But that said, if the rate of change is really sharp and yields move up a lot really fast, it hits everything. So valuations on everything get crushed.
Grant, what's your opinion? Do you think it's possible the Fed's going to get caught flat-footed and have to do a surprise rate increase because inflation is now spinning out of control? Right now the Fed's saying we're not raising rates. There's no way, we're never going to raise rates. I don't think they're going to do it anytime soon, but I think they're going to do it sooner than the market had priced in. And that's really, and that's really what the market is repricing now with, kind of that relative weakness in tech. So they're expecting it sooner. Inflation is a funny thing, or at least hyperinflation. I don't know that we get that because, the dollar is the reserve currency, but it's more of a psychological event than it is a pricing event. When you get into hyperinflation, it's just confidence is lost in the currency. So it's kind of hard to imagine that happening with the US dollar. But, if we go into like MMT and start, putting people on weekly stipends, like, it seems like some of the factions are moving towards that kind of thing. And
the government has figured out that because we print our own money, they really don't even need to sell treasuries. I mean, they're just kind of doing it, but they don't need to. I mean, if you listen to the proponents of MMT, they're like, all you need to do is print the money. You don't even have to sell the treasuries to finance it. You print your own currency. Don't worry about it. The only thing that would restrict you from printing more is inflation. And if that happens, then you dial it back. That's their whole case. And their case is that you can rebuild America. You can put people on stipends where they don't have to work, and we can just print this money. So if we get into a situation like that, yeah, I think, you could have a hyperinflationary kind of just breakdown in the dollar. But I do think, like we looked at this, and I love this chart too, the gold copper ratio, which I just put together with CPER for copper and GLD for gold in red. But it tends to lead, over here, you can see rates moving higher. It's leading lower over here in red. Over here, it started leading higher well before rates. And it's, up at a level where the 10-year yield would be at 3%, where it's half that right now. So
there's the Fed getting caught flat-footed right there. I mean, there
yeah,
it is.
Well, that's what I'm saying is the Fed is saying one thing. Most of the Fed, Kaplan is not. Like Kaplan this week, the Dallas Fed president was saying, he thinks they should be talking about tapering a lot sooner than later. And he's raising yellow flags. And Yellen kind of came out and said something like rates need to move higher. And then she tried to backpedal, and of course, because she's part of the administration. They know this. So they're trying to keep confidence in the market, saying we're not going to do anything. But if you look at commodities, the way they're trading, they're not buying it, they're not buying this transitory, or at least they're preparing for something worse.
Right.
No, politically speaking, what they're doing is laying the groundwork for the raise that's inevitable.
For the raise that's inevitable,
Yes, that's
the hike.
when Yellen comes out first, and then not only one but two other members begin saying, in whatever method they do, this is politics. They're laying the groundwork for what they're calling transition, but they know that's a lie.
I thought that too, but yeah, I mean, I considered that. But then on the other end, you've got, like Bullard and Clarita and Powell that are just, I mean, he's just insistent that, it's going to be lower for longer.
So I have a question on the copper gold. Is there a day trading, other than for swing trades, is there a way that can be used in a day trade situation on futures or?
I mean, I haven't checked that out in close, but like I kind of showed you before.
Or if for the 10-year futures or 30-year, would that be anything that you could use on a day trade?
You might be able to. I don't know if this shows up really. Like if I zoom out, shows up a little bit better. Let me zoom out. So can you see? Okay, can you see this little bull flag right here?
All right.
Yes.
Now, TNX here, the 10-year yield was doing the same thing. It had a little bull flag. This broke out a week before. TNX actually did start breaking out, and this week it's acted really weird. I don't know. It's rates have come down as we get all this inflationary data. It may be some kind of first of the month rebalancing or something. I don't know. Yields have acted really strange, but the point is they started to break out. Just 1 week later, they followed this breakout. So they started that breakout. It's more, to me, it's more of like a macro signal, more of a longer term trade, but I think it's worth investigating. I just haven't looked at it that way. I've looked at it more of
could you leave the copper gold on there and put it on a 1 minute and then
Sure.
overlay the
TNX
10-year, well, the TNX or the 10-year futures?
Well, see, this is what's been acting really. This is TNX. Hold on, let me get to 1 minute. So this is TNX. So this is, this week here from the 3rd. And this is what I've been saying like all week is that we got inflationary data in ISM manufacturing and non-manufacturing, which is services. Usually I would have expected yields to have really gone higher. Instead, they drifted lower, kind of a strange thing. But as you can see, it kind of does track with this copper gold ratio over here, at least until we got to this weirdness this week. So if you were like to use TLT, you would have to like invert it, you know. So throw TLT on there, and because prices of bonds move opposite of yields. So, you know, you could use it that way and look at it that way, or you could invert this ratio and leave TLT alone. It's something worth exploring, but generally I think it's more of a macro trend that takes a little bit of time to develop.
Do you have the ability to overlay the 30-year on that?
Sure.
As opposed to, and not inverted, just
The 30-year yield?
no, 30-year, the 30-year futures contract.
This stock finder doesn't do futures, but we could
Okay.
probably do it. Yeah, I don't have the copper gold
That's
ratio
fine.
set
Well,
up on TOS.
I know if the TNX is going down, or then we know the futures, the price of it's going up. But I was just trying to figure out the magnitude, so that's all.
And what this red line just means is that copper is outperforming gold. Now they're kind of like two sides of the same coin. Copper is an inflationary thing. Gold tends to be more of like a safe haven asset. Yeah, so I'll put together the copper gold ratio and TOS and a like a term structure
That'd be great.
for volatility.
James, are you done?
Yes, I'm done. Thank you
Okay.
for putting up with me.
Oh,
No,
sure.
James,
When
thank
you're
you
ready.
for the questions. Great questions.
Yeah. I've got a question from a member here that asked me to ask it. So when you're ready, Brant,
Sure.
I'll read it to you. Ask about how 3 seems to change retro after it has already printed as price moves forward.
It might be a scaling issue they're talking about. I'm not 100% sure.
I'm not either. I'm not sure what that question is.
I think it is scaling.
Yeah, so like I was showing you earlier, if we look at this area here, you know, the last couple of days, and
Yeah.
just watch where 3C is relative to price.
Hmm.
You see how I change the scale, and right there, it's right with it. Right here, it's a little bit above it. If I come in more, it's a little bit below it. So I suppose you might be able to lock the indicator to price, but to me, it just doesn't really matter, because what I'm paying attention to is higher high over here. Did 3C make a higher high? You know, that's all I'm looking at. So over here, price makes a lower low, 3C makes a higher low. That's a little relative positive divergence. Price tests that same area. Oh, sorry about that. I know I have so much trouble pulling up a pointer. So here's the first low, sharp sell-off, kind of a little flag here. And I was looking for a break of that flag, but a test of this low. So if you see, price is the exact same place, but 3C is even higher here than it was over here. So small positive divergence, another one confirming basically a successful test of that low. And then the next day we got that kind of, Friday, we got that strong move up into the gap, filled the gap and kind of back tested the bottom of that 3-4 week range. And right now it's still kind of in line. You can see it's a little bit more positive here leading up as prices are down, a little more positive here. And it's kind of in line. This probably maybe is like a little bull flag or something, because we have that resistance. So I would think, you know, towards the start of the week, there's probably a little bit more upside, or attempted upside anyway.
Part 2 of this question, Brant, is, let me read it. Also, should it be viewed full screen or zoomed in, as when you zoom it, it changes its appearance also? Yeah. I think we answered that.
Yeah. So like I said, I've got some people who are using it on like 4-hour time frames, and they're not looking at like the trend. They're looking like real close. So they'll be looking at something like this. And, you know, on a 1-minute chart, this isn't significant, but on a 4-hour chart, that kind of divergence would be more significant. So what I've noticed is people who are using those longer charts tend to look at it a lot closer. Pull up ES real quick.
I think that person's question is a looking at it on TOS, and there's the zoom in, zoom out feature on the charts. And when you do that, it moves 3C around
Yeah.
in relation to price.
Yeah. So yeah, you can see the settings I'm using here again, 20, 50, and 2, which is the same as that orange one in a stock finder. So yeah, and that's what I was getting at with, I think somebody asked, if price crosses below 3C or 3C crosses below price, you can change all that with scaling. So that's not important. But if you do see price crossing below and you're at a pretty static point, it's more than likely that you're seeing a divergence, for that to happen. But you do have to keep that scaling in mind. And the way I just kind of look at it is, a lot of times you can scale it. So it's pretty nice. Travel's pretty nice with price, especially on stock finder. It's real easy for me to do, to get the two to move together. But that's just so people can see it easier. Here I can see very clearly that, and by the way, this is that kind of broadening top that was going on during the whole trade war and all that stuff, and prices above it here. But what I can see is that 3C's been making lower highs relative to, where it was back here, while price is making higher highs. So on, this is a daily chart. I think I've been seeing people using 4-hour. I don't use these a lot, but they'll come in a lot closer and look at stuff like this, So this divergence right here on a 1-minute chart will look like nothing. It won't be important, but because a 4-hour chart, it takes so much more to move that time frame. It's a more important divergence. You know what I mean? And over here, it's starting to lead, which is the same thing. This is ES. So the volumes, remember 3C is price and volume. So even though price might move similar between ES and S&P or SPY, the volume is going to be completely different, yet we still have the same trend in this area, whether we're looking at SPY or ES. So I would just say, not to be aware of the scaling issues. I'm sure there's probably a way to lock it, but it's just looking at the trend really, higher highs, higher lows, lower highs, lower lows.
Yeah.
And the stuff, the more you use it, the stuff that really stands out. And I mean, if you look at this chart, this 4-hour chart, this is pretty good confirmation of the trend. You get a little dip here and a little pullback, a little dip here, a little pullback, right? But it's pretty good confirmation of the trend until we're getting in here. This is getting a little bit more, I wouldn't say it's like screaming jumping off the chart, but it's probably the most interesting thing that's happened. This was probably the most interesting thing before that. So this is a larger divergence.
Mm-hmm.
I mean, if you look at where 3C kind of came down, where price was over here, it's a pretty big difference.
If that 3C does not continue up, that would argue for the short side. I mean, if that,
well, that could argue for, like a false breakout or a bull trap kind of thing, which is
right,
kind of what happened last week. More so, it was stronger in S&P, but Nasdaq was more susceptible to it, because of the inflationary story.
mm-hmm. Yeah.
So, any other questions?
Could you put the Nasdaq on that chart?
NQ?
Same one, yeah, NQ for the Nasdaq traders. We've got quite a few of them.
NQ. So let's see, what is this? February. This is okay. So February is, you can see kind of diverging into February, and this is probably the ugliest sell-off that we got since then. This is when yields started breaking out and moving up at a faster rate of change. Let me pull that up real quick for you. I'll show you what I mean.
So it's
you guys are still looking at TOS, right?
Correct.
Okay, so let's see what these dates are here. This is January, and then right in here is mid-February, right?
Yeah.
Now I'm going to show you 10-year yield
with rate of change.
I don't even need it. You'll see it.
All right.
So here's the 10-year yield kind of drifting up, and here's mid-February. I mean, you could see the rate of change just blow out of this channel, right? Mm-hmm. And this is when tech stocks started acting weak.
Mm-hmm.
And the only time it really seems to affect like the cyclicals and by extension, small caps, is if there's a really sharp rate of change, like a 10, 20 basis point move up, in a couple of days, then it seems like it just spooks the whole market and valuations across the board adjust. But generally speaking, those cyclical sectors, the value sectors, they're more immune to rates moving up.
Brian, can you show us more data on that chart?
On this
yes, farther to the left, farther back in time.
So here's a daily chart. So this is that disinflationary. I mean, look.
That's what I wanted them to see.
Talk about, price action being like amazing. You see this bear flag right here?
That was your second chance, third and last chance to get into the.
So let's see. Let's just see what the measured move is about here.
Look at where we are
44.
Relatively.
Wow, that's big. So I don't even know where to take this from, if this is like a first leg. I was kind of taking it from over here, but that's a pretty impulsive leg, 55%. And there's about where that flag breaks. That's the second leg, 75%. That's massive disinflationary. And this is one of the things, when we're looking at those commodities that were just peeling off to the downside right before the COVID crash. Well, you also had stuff like this, like a bear flag in rates. And when I was like really freaked out in 2018 that I thought the market was going to see rates move up and stocks crash, was right back over here again. Because look, it's like bull flag, little consolidation, and a breakout right here. This is
October 4th.
Yep, and the market sold off, right from there, right into December. That's kind of the same theme, except it wasn't really inflation. It was the Fed was like, I think October 3rd, Powell said, we don't know what the neutral rate is, but it's higher, which he was saying we're going to continue hiking rates. And he was like, just like he is now about, inflation being transitory, he was adamant that they were going to keep hiking rates. And they hiked again in December when everybody's screaming not to. Trump was going crazy on Twitter, that he was hiking. And 2 weeks later, the market was right and they stopped hiking. They reversed. They started cutting. They started buying assets again. So, they're not infallible either. They're not omnipotent or anything like that. And a lot of times the market just bends the Fed to its will. They say don't fight the Fed, but there's plenty of examples of the market, the taper tantrum, stuff like that.
Grant, if I can speak to the value of the other members who are here, this is an example of the value of Brandt's work, because I view him as a Sherlock Holmes in the market. he is constantly reaching down and picking up a stone, picking up a piece of wood, turning it over, smelling it, and he starts smelling things as he's been describing by looking at the components of the indexes. And on the 4th of October, I've told you this before, Kirk was in Florida at a HVAC meeting, and he sent me a message somewhere, I don't remember how, that said, this is the day to sell everything. Kirk followed that move all the way to the night of the 24th of December. The night, late in the night, just before the market closed on the 24th of December, and he sent me another message, reversing all longs, all shorts.
Oh.
So the value of Brandt's work combined with the experience of Kirk gives this room and this group an incredible insight that many of us don't have. This is experience and years of practice in full view here. Thank you very much.
Well, thank you. I appreciate it.
It's all Brandt. It's not me. I just do what Brandt says to do.
No, you played that trade a lot better than I did, because I got on Nasdaq out of my short when this kind of channel broke to the downside. I was like, it was kind of like this channel buster theory I have that
you got to be kidding me.
I don't really have it drawn in that great. Let me see if I can just kind of approximate it. So there was this kind of channel right here, and when Nasdaq broke through this, I covered my short in QQQ, but that was, I think, right about here, the 20th or maybe maybe this day, but it wasn't the 24th. I didn't nail the bottom like that. I think I was short small caps first, because usually small caps tend to get hit, at least in this case, tend to get hit hardest first. And then, you know, the Nasdaq or the mega cap stocks that have been favorites for 10 years, if there's a second leg, they tend to get hit. So I switched to Nasdaq for the second leg down over here. So it's like, you know, first leg consolidation, second leg, pretty messy, but still.
Were you using the IWM or some for the
I used IWM right here for the first break.
Right.
And then somewhere in here, I switched to Nasdaq. I can't remember where. I think it might have been right here. I went short Nasdaq.
So for people who trade futures, right, even though they also trade options, if you were short the IWM either outright or through being long puts, but the IWM kept going up, you could always take the upside with the Russell futures to hedge your short position in the IWM or the long puts that you have, correct? And
yeah, you could.
If it goes against you, I mean, granted, you could always just close the trade out, but if you still believed that you had the conviction that it was going to drop, you can hedge it off with futures.
Oh, sure. Yeah. I personally, just because of my kind of, you know, what I do and my schedule, trades for me are secondary. Like if I see a lot of stuff, you know, and I point stuff out, but I can't manage, you know, a scalping day trade and get my updates out on time. So the trades that I have to take are ones that don't require, you know, my attention every second of the day. So, you know, I've been in like GBTC for a while and ETCG just because they've been trending well. But here I'm just showing the Nasdaq 100 and small caps are IWM in blue. And remember, I was saying that at like pivot points, small caps tend to lead risk sentiment. So you could see them negatively diverge here. They make a lower high relative to the Nasdaq here. So they started leading this leg lower. That's why I like to be short, generally speaking, short small caps first on that first leg. And then, you know, usually like the Nasdaq and mega caps will hold up better. People just don't want to let go of them. And then when they really get bloodied and a second leg starts down, generally those popular stocks will get sold. Yeah, but I love watching small caps relative performance versus, you know, the S&P or versus the Dow. It's been really a mess here. You know, I mean, in March, you see big rotation into them. And then you see in April, it kind of went back towards the mega caps and NASDAQ. So yeah, it's an interesting, I mean, you don't always, like I said, you can't torture the chart to tell you something, you know, that you're looking for. You just have to wait until it materializes. And when you see those things, that's like when I swing for the fences, you know?
Yeah.
It's interesting how the Qs came up on that chart you're showing. If you go to the left in March and look at the high in March, it's kind of a very exaggerated head and shoulders pattern. But if you look at that high on late February near March 1 in the Russell, the blue line right there.
Yeah.
And then the Qs start their rally and come, or the end NASDAQ, and they come up and their high is almost just right at those peaks, those lower peaks of the Russell, not at its ultimate top, but then they start rolling over. But the RTY had already formed what I would call a head and shoulders, and then it's has lower highs, lower lows, and now the Qs are going to.
Yeah, I agree. I think that could be.
So anyway,
let me pull up. Yeah, I think there could be like a complex head and shoulders here in IWM.
Yeah, right. Yeah, it's not a simple one. It's
I mean, you can see, I guess that neckline's around, I don't know, 213 or so, 212. Yeah, I mean, there's a couple things like that, like emerging markets, you know, EEM. There it is. And then with EEM, here's a little trick. in emerging markets, they're really sensitive to the dollar. The dollar goes up, it kills them. So in most cases, the emerging market currencies will tend to lead the equities. So you can put a comparison symbol, and what's the one I always use? EMLC. So this is just like a basket of EM currencies. And that's in yellow versus EEM over here. And what you'll see is the yellow line, the currencies they tend to lead the equities. So like if we're looking over in here, I mean, the currencies are just ripping higher. And now when we get into this potential head and shoulders here, you can see them like negatively diverge at the head and are leading lower here. So if by some chance the dollar finally gets its act together, these would be, something I would really look at for a short, to play maybe a move down to like the 200-day moving average. Yeah, like right in there. But, it's one of those things where it's going to take some time. You're going to have to be able to build a trade where you can sit in it for a while. In risk management, like the Nasdaq had a similar head and shoulders, and it just blew right through that. Let's see where I have it. It had like a similar head and shoulders here, and it blew through this 50-day, and that was it. That was kind of like the little breakdown here. I thought it would back test here, but it did a little bit better. Kind of got this little right shoulder thing going on. Again, it's not a real the head and shoulders never look like the textbooks,
Right.
But right there, that was over. Once you hit that 50-day and right through it. So, and that's where it's been holding support, or at least the Nasdaq Composite has. Yeah, right there at that 50-day. So that's why, I kind of think it's going to be choppy going in the next couple of weeks, because you got this range of overhead supply here for the Nasdaq, then you got support right below it, and yields just been acting funny this week. I don't know.
So Brent, can you address the dollar, given the fact that there's higher interest rates, which is attracting dollars, which causes emerging market debt to have real serious problems because they're having to borrow dollars to repay their debt. Borrowing those dollars creates demand for the dollar. So you have a supply and demand situation that is pulling the value of the dollar up. How do you reconcile that with
how it's acting
with the inflationary effect?
I would generally expect the dollar and yields to move together, but there's so many different undercurrents right now.
Right.
The Fed's mission, really, with all that loosening, was to crush the dollar. So let me just pull up a different chart here. What chart are you guys looking at right now?
Composite with 50-day.
Okay. Let me just pull up a different chart here real quick. Do like just a quick comparison. You'll be able to see this. Okay, so what I'm going to do is just pull up UUP, which is just a little ETF for the dollar. And then you got the S&P 500. So there's an inverse correlation. So what I'm going to do is invert UUP. And what you'll see is the Fed basically crushed the dollar. So the dollar, UUP moving up here is the dollar moving down because I inverted it. But they crushed the dollar and stocks rallied. So recently, the dollar had been strengthening in here. So this was something I was watching. Then, the last few weeks, we've had a lot of dollar weakness. So, but you can see how the S&P is pretty much tracking with an inverted dollar. The weaker the dollar is, the better the S&P is doing. And that was, the Fed's plan was to crush the dollar. So you have those two different dynamics of inflationary factors and what you're talking about, the emerging markets. And I believe they have a shit ton of debt coming due this year.
Mind-boggling.
Yeah, I think they could really be in trouble. And usually those are the kind of things that people would be looking at in inflationary play. But I am looking at EM, keeping a real close eye on that. If the dollar strengthens a little bit, and those emerging market currencies start leading lower, I would definitely look at a short trade there, down to the 200-day.
Keep us posted.
Oh yeah. I'm watching that all the time.
If the Fed has a surprise rate increase, will that rocket the dollar and dump the market?
Yeah, well, the other thing about the dollar is that its performance is also relative mostly to the euro, but to other currencies. So if the ECB is easier in monetary policy than the Fed, then the euro will tend to be weaker, the dollar will tend to be stronger, even if the Fed is still easing. But if the ECB is easing more, or the Bank of Japan is easing more, that will tend, it's kind of like how is the dollar or how are the central banks relative to each other, and that affects the dollar. So the dollar has like a weird relationship with stocks. They call it, I think, you guys know Raoul Pal?
Yeah.
Yes.
Yeah.
Big fan. Yeah.
Yeah. So he talks about the dollar smile. So sometimes when the dollar's moving up, it's an indication of, money coming into the US. I think like 2017, 2018, that was happening. Money coming into the US, and it's a positive thing. Then at other times, that whole dynamic flips. So there's not like one steady, consistent relationship between stocks and the dollar. So it can flip, depending on other central banks' policies, their rates, who's easier, debt, stuff like that. So dollar can be a little bit complex, but for our purposes right now, a stronger dollar would be a major headwind for stocks, and a weaker dollar is going to be a tailwind.
And so if there was additional tightening globally by the Bank of Japan and the EU moderated, that could be
any additional tightening
will be a headwind for the equities. True.
Yeah, and it doesn't even need to come from the banks. I mean, rates moving up or the dollar moving up, that's financial tightening.
Okay.
So I think that's probably why Powell is trying to, really talk down the notion of inflation beyond transitory, is because he doesn't want rates to move higher. I mean, they're trying to keep the Fed funds rate at 0. They don't want the 10-year taken off to 3%. So I think, that's part of his mantra of just, inflation is going to be transitory. It's going to be transitory. And nobody knows. I mean, nobody's dumped that many trillions of dollars between fiscal and monetary at the same time.
Since 2008, this has been one big experiment, and no one has ever been in this experiment. So you don't know how it's going to end up.
There was a similar analogy.
Yeah, there's been one.
From 1929, the Fed actually cut rates back then down to 0. They actually bought asset purchases back then. And it was kind of almost an analogy between 1929 to 1936, where the market kind of came down again, kind of almost an analogy between 2008 to now, or let's say to, the last crash last year. So there's kind of an analogy for that. I mean, they have done this stuff before, but obviously not to this degree. And if you pull up like a chart of the Fed's balance sheet, the S&P moves damn close to it. And the thing is, it's not just where the balance sheet is, if it's high, it's that they have to constantly keep it moving higher. They have to constantly add more money to be effective to move the market higher. But you'll find that they track incredibly similar.
Yeah.
Because all that money just goes straight into the market,
At 0 interest rates, there's no place else to go.
Yeah, I mean, they've basically pulled demand forward and forced everybody into the market, So I don't know. I mean, they've gotten away with it for, 15 years or whatever since Greenspan, but you would think at some point, this is going to come back to bite us.
Well, Kirk and I talked several times, and I talked about the slippery serpent of the bond market and the Fed losing control of it. Sounds rather radical, but do you see any scenario where that might happen?
Sure. I mean, that's what that copper gold ratio is saying right now. I mean, if the 10-year doubled from here, went up 150 basis points, I mean, that would be that'd be huge. I mean, that would
Okay.
be a massive policy failure.
Mhm.
I mean, we're talking about 10, 20 basis point moves causing the Nasdaq to sell off 8%. You're talking about 150 basis points, you know.
Mhm.
I mean, it wouldn't happen overnight. And I'm sure, you know, they would try to talk it back down, but they just have less control over the long end, you know.
Mhm.
The market's bigger than the Fed. That's what people think. The Fed controls the market, but the market controls the Fed.
Oh yeah, the market, yeah, like that 2018 example. I mean, they forced
Yeah.
the Fed to completely change from hiking rates and rolling off their balance sheet to
Right.
cutting rates and buying more assets.
Right.
By intimidation.
Yeah, well, market goes down 20%. You're getting calls from the president like, "Hey, man, what are you doing?" Yeah, he changed his mind pretty quick. It was 2 weeks after the last hike. He started, we're done. We're on hold.
The pivot.
Yeah, the pivot, right. And you know, I it's just, it never ceases to amaze me how much, you know, how little the Fed has to do to really move the market. I mean, they don't even really have to buy that much. Just come out and say they're thinking about it, and it's like, you know, the market's just so like Pavlov's dog. You know, it's like so conditioned to stimulus.
Yep.
That's now. Nothing fails like past success. So you could also argue that at some point in time, when that doesn't happen, Katie bar the doors. I mean, and that could happen.
Yeah,
You know what I'm saying?
yeah, and
Mhm.
people like Kaplan are talking about that. You know, the Dallas Fed president just this week.
Right. Yep.
And like somebody else said, you know, Yellen may have let that slip. It would seem she's smarter than that, especially that she's part of the administration, that she wouldn't say something like that. So you may be right that she's kind of like putting it out there, kind of.
Called
Yeah.
floating.
Yeah.
But after three people say it, it's no longer floating.
Yeah.
I just wish I had a chart of how extreme the valuations are, so you could see. I mean, they're so extreme compared to the, you know, what we've seen historically, even at 2000. So it just takes rates moving up 50 basis points or something to reprice like horribly.
Mm.
And then look at sentiment. So you combine valuation with sentiment. It's insane. I mean, it is absolutely crazy.
Oh, I mean, ETCG, that Ethereum ETF, I mean, 200% this week, it was up. I mean, those are people taking their stimulus checks and just jumping on the trend, you know?
Yep.
And these
Bitcoin,
NFPs.
the non-fungible
Yes.
tokens, or the artwork.
Oh my God. So that's why this meeting is so valuable, in my opinion, because, you know, these things can happen so much faster than anyone believes. And
oh yeah,
just all it takes is some strange thing to happen. And we
look
can
at
just
COVID.
and
Look at COVID.
what's happened today is you've given us a very good framework to keep our minds open, ready to trade what Kirk calls the waterfall.
Oh yeah, those are fun. That's what I spend a lot of time looking for those.
Yeah.
I pay attention.
Well,
It's easy. It's easy to see the markets trending up, you know, but like I said, if you see copper moving 10, 20%, you know, up or down, that's in a relatively short period. That's a major macro signal, you know, that's a leading signal.
Yeah.
Mm-hmm. When the waterfall starts, the best thing I do is get in my car and drive away, because if I look at it, I'll trade it. I just leave.
I know it's hard to.
You lie. You're
hard.
not in your car. You have your computer in your car and you're trading it like crazy. What are you talking about?
Sometimes I do trade in my car. Don't tell anybody that. Art.
Talk about a dangerous driver. No, he's dangerous. He's dangerous in Starbucks.
I have to admit, I was driving back from Asheville and doing a little bit of that too myself. So
Fanatics.
Do as I say, not as I do.
I know.
Okay.
Thank God for hotspots.
Any more
Yeah.
questions? This has been incredibly valuable, Brad.
I had one thing I want.
Please.
Brant, would you mind going to your toss charts
Mhm.
and putting YM on because there's nothing going on today. It can't be today 1 minute, but go to a 1 day, 1 minute chart, YM, 1 day, 1 minute, YM futures with 3C. Thank you.
So, yeah, I mean, look at the,
So
let me get rid of this correlation.
So my point is, if you'll look to the left, and this is something that I pointed out, and Art has asked you about it on my behalf and for behalf of the rest of us. If you look to the left, 3C down at in the overnight, you can actually you'll see the low of the 3C down there.
Yeah.
And price comes down and hits that low and then bounces.
The extreme low, Brand.
The extreme low.
I see what you're saying.
And then that happened at 2200 hours. And you can, if you go over to the left and hit the little arrow in the middle of your chart over on the left, come up.
Look at
and
that.
There we go. So now you will see what I do in the morning, but I have it set for today 1 minute. And because it confines everything for day traders, you're worried. Granted, we look at, go back in history and look where our highs and lows and all that are. But what I've noticed is that if they're going to shove it down, where is the move down going to stop? Well, I've noticed that it stops at the low for whatever low the 3C made in the overnight.
That's really interesting. I have never.
And then where is it going to go once it goes up, and where is it going to stop going to the top? And you go look at the high that 3C made at 10 o'clock, and price ended up going over there.
Right
and
there.
Kaboom.
That's very interesting.
And then all your other little peaks in between the high and the low become kind of over under areas. And then your flat spots in there, you can draw horizontal lines and see that those are going to be consolidation and accumulation, whatever you want to call it, just little areas where I call them over under areas where they have to make up their mind. Are we going down? Or are we going up? And so it's been consistent. I mean, on a today 1 minute chart, if you put that on there, if you went and said today 1 minute right now, your chart would be blank. There wouldn't be anything on it. So anyhow, and the low was 34,366, which matches that low at 22, almost 2,300 hours. And
that's really interesting. That's why, like I say, make the indicator your own, because people, view things differently. Their minds work differently. This is something interesting. If you see this more.
No, it's every day. This is not on occasion. This is every stinking day.
For at least a month now, James.
Yeah.
At least a month, isn't it, James?
Yeah. I mean, I've noticed it and shared it with the room at least a month ago. So.
Yeah. I mean, what stood out to me was like the positive divergence right over here.
Right.
Yeah.
Versus where 3C was over here. And then, of course, this positive divergence into that sell-off. So those were the first things I was looking at before you said this. That's really interesting.
So if you're late to the party, but you still want to catch the down move, you say, where is it going? Or if it's down there, do I want a chance going to the long side? Well, you've got a pretty good idea that 3C held at 2,300 hours and started up. And it's actually still going up during the trading day while they're hammering price during the non-farm payroll just to rip it back up, but and 3C was continuing to go up while price was getting hammered in the aftermath of the non-farm payroll announcement.
Yeah, that's really interesting. Yeah, it's like you could set targets or stop losses or, kind of get like risk reward ratios before you get into a trade. Like, what is my potential reward on this? Well, I think it's going to come down to,
right,
34,375 or whatever that may be.
Correct.
Yeah, that would be very helpful. That's very interesting. That's very interesting.
But anyhow, that's just, to me, I don't know. I was just wanting you to look at it and either say you're full of it or here's the reason it's doing it. There's a quirk. I don't know, but I just, that's,
No, I mean, in theory, you know, things don't always go like, you know, we're designed to, but in theory, 3C is kind of leading the price trend. That's the idea, or it's confirming it. So it's not unreasonable that you're seeing this. It's not out of the question that this is something. I've just never paid attention to it. I never noticed it before, which is one of the fun parts of working with other people. So
James, inversely, if it's at the top peak at 34, whatever, it's about, you're saying that's the top, and more likely than not on Monday, it should be going down.
no, I would again look at the overnights. I would have my chart set to catch the from Sunday at 5 to the open.
yeah, he's kind of setting his targets before the market opens.
You work from left to right, not from right to right.
Yeah, I would say I would want to see what they did on Sunday because 3C will start again at 5, and so anyhow.
But Mark, excuse me, Mark, you see the potential for what James is seeing here to catch that low in the middle of the page of the chart?
Yeah, absolutely.
Isn't that incredible?
Yeah, that's phenomenal. That's why I'm saying the inverse of that is the top of the triple C, and now we're reaching the top of the triple C. I understand what James is saying in terms of looking at the overnight Sunday into Monday, but if it's a continuation, in other words, if it's stagnant or drifting lower, then the odds are that triple C should be coming down on Monday morning, and S&P should be coming down in lockstep. Is that correct? Is that a correct statement?
Let me address this from a day trading perspective. If you go right halfway between the 1500 and 1600 hours, looks like Brant has his set for East Coast time. Where the first touch, go to that big red candle to the left, a little bit more. That red candle right there was almost the first touch of the peak of 3C at 10 o'clock in the morning.
Yeah, and there's resistance on that candle too. See the long wick.
Resistance, and it gave you a nice short for the first time. And then the last touch was right at the close where they were running it up into the close like they have for the last 4 days. But that first touch of the peak of 3C for me would be to be short, to take a short trade on the first touch over at say 15-30 hours.
Mm-hmm.
And then
you could have stops above that or
to protect you. Yeah. And then if you wanted your other potential first short, it would be taking your horizontal line anywhere there's a little kink in 3C or a peak where you're going to see where sellers, at least in 3C, came in, so anyhow. But the way they've been closing this thing and going to new all-time highs in the last 10 or 15 minutes, I would probably have stood off. But that first one, 30 minutes before, see, what is 15:30? It's 3:30 your time, 2:30 my time. So at 2:30 Central Time, that would have been a possibility to short. And it was a good one. It went from 725 to 675. That's 50 points on the YM. It's nothing to sneeze at.
Yeah, I'm going to be watching that. That's really interesting. I didn't quite grasp the question until you showed me this. Yeah, that's really interesting.
I'm glad you brought this up again, James, because I think it's really important for Brant to begin watching this. But it's been very consistent for a month.
Yeah, that was great.
And I've got a 2-day 1 minute, James. So I'm trying to look back the previous day to see what Mark is asking. How did it finish the previous day coming into the overnight?
Mm-hmm.
But I have no doubt we're onto something. We're going to learn how to trade this.
Your other opportunity for short, just with 3C with nothing else, comes at about 1430 hours on Brant's chart. And that top of price happens to be where 3C at 10 o'clock Brant's time formed a little, keep going to the left and go up.
Go up,
Mhm.
form that flat
Come down.
spot, down.
Come down, go over to the left just a little. See that right there? See that area right there? Now, if you go up, you've got a right in there. You can just draw your lines. I use a horizontal line study, and on those things, I just have a white dash line and I mark them. And if you go down to that little peak where you are now, just right before 10 o'clock.
Right
Right
before 10 o'clock.
Yeah,
Right in here?
right in that gap between that peak and that flat spot to the right, you see what price did. Price came in and played that and hit right in there. And
Kind of
then
like resistance, yeah.
you had another 50, 25, you had another 40-point drop. And in the YM, it's $200, you know?
Yeah, if you see more stuff like that and you have like an ability to capture the chart, maybe you could email some of the,
All right.
or how you're putting trend lines on and stuff, just so I can see a little bit more, because that's definitely something I want to check out.
This is an edge.
Yeah, I mean, that's the thing, you know, it's been me and a few other people using this, so it's not like you've got thousands of people using, you know, MACD and coming up with all kinds of different things. So there's a lot of discoveries, I'm sure, to be made.
James had asked me this a while back, and I had never observed it. And I said, you better ask Brant, because my only concern is the scaling thing. Like if you put that on a 5-minute, do you still have those same points?
Well, a 5-minute chart will look completely different because
but
it's accumulating a 5-minute bar rather than 1-minute bars.
Right.
I guess you don't care as long as you have a chart.
Kirk, it's irrelevant.
Yeah, you're right, Art. You're exactly right. Yeah,
we're trading the 1 minute, and Mark trades the 1 minute with a 25 tick entry.
Right.
So if we just settle on one strategic way of trading this, I'm totally confident that James has found an edge.
That's really interesting.
Let's test it over time, guys.
Yeah, we've been watching it for a month.
Yeah, put a little thing on your chart right there. Yeah.
Mhm.
See, everybody's mind works differently. Everybody sees, you know, a chart in a different way, and that's part of the cool thing of what you guys are doing.
It's really a kick, isn't it?
Yeah, it is.
I told you, Brant, this room is full of very smart people.
Oh, I know that. I know a couple of them in there.
We got some really, really talented people in this place. Okay, I'm wearing out. How about everybody else?
Thank you, Brant, for your time. And we just go to your website, Wolf on, you want to, I always get the website messed up. Wolf on.
Yeah, very much appreciate your time, Brant.
Oh, my pleasure. Absolutely. Here, I'll pull up the website for you.
Yes, thanks so much for coming.
Oh, thank you for having me.
Been fantastic.
Let's see. It's right here, wolfonwallstreet-trade.com. And I had the name of the website well before the movie, so I don't know.
Oh, did you? Okay.
Yeah.
Okay.
Changing it.
They copied you. They got it from you then.
I don't know. It was just a coincidence. I don't know. I had it a couple of years before that. And then, you know, for SEO on Google, it just killed me.
Yeah.
You know?
We don't want to ask too much or overstay our welcome, but maybe we can do this again someday.
Yeah, I'd be glad to.
Yeah.
That would be wonderful. We do this again in 4 or 5 months when we have some time to prove these concepts. And especially if we begin to approach a waterfall, maybe we could do this when you begin to see that top begin to fracture.
Yeah, I think the main thing to watch is like the 10-year yield or the 30-year yield. If that really starts, you know, making new highs or new cycle highs since last March, I think you'll really see trouble in Nasdaq. And if it does it real fast, you know, a sharp rate of change across the board. So if it's going to hit Nasdaq, it's going to hit S&P and Dow to some extent because they have that mega cap exposure too. Small caps would probably be the most immune to it unless the rate of change is really fast. The jump in rates is really fast, you know?
Okay, well, I thank you all for coming. Cindy, thank you very much for running the room for us. Brant, cannot thank you enough.
Oh, thank you. Appreciate
Superb job of answering the questions today. I hope we got everybody's questions answered.
Yeah.
And, I bid
And
you all
I'll
a
put
good
together
evening.
a couple of those indicators and send them to Bill or Kirk or to Art, and you guys can check those out on TOS.
Oh, great.
Yeah,
Oh,
Thank
very
you.
sure.
Thank you. Thank you all
Thanks,
very
Brant.
much.
Thank you, Art.
Thank you, Kirk, Brant, James, everybody. Cindy,
Okay.
Mark. Good
Have a
evening.
great weekend, everybody.
Right.
Thank
Yeah, you too. Bye-bye.
Okay,
Yeah,
bye-bye.
thank you. Bye-bye.